The US has a dynamic economy, a strong labor market, and it will outperform a lot of peers.
There are sufficient signs of weakening.
You see consumers cutting their spending back, but continuing to get jobs.
Job growth is slowing down. You could see a bigger slowdown starting even in the next jobs report.
Unemployment rate has been the most important data point you get, for a while now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Deadline day coming in with a bang, a flurry of new tariff announcements roiling stocks. Meanwhile, a blockbuster week of tech earnings revealing some divergence in the American exceptionalism story. And the true test is in the data. The July jobs report dropping about 2.5 hours from now. A quiet, just end of summer month. Annmarie, welcome back. We learned a lot overnight about a final tariff rates as well as a slew of different trading partners and how they're dealing with that. How much remains to be seen?
A lot remains to be seen. I mean, these are writ large the highest tariff rates we've seen since the 1930s. Across the board, everyone's going to have a 10% minimum. Then for a number of countries, it's 15% or higher. So we've seen the Trump administration do. Most of these trading partners who thought 15% was going to be a bad deal, that's actually become the base case for a good deal. Then there's a number of partners I'm focused on because in the White House statement, it talks about how these rates for a slew of partners like India, like Switzerland, will go into effect in 7 days. So even in this final deadline that the president said is best and final, they're giving some of these trading partners, I'm thinking of Switzerland right there, top of the board, 39%. April 2nd, Switzerland was 31%. I think they're still giving some of these partners some wiggle room.
Well, that's the idea of August 7th being the time when it actually goes into effect. The wiggle room, the negotiations. What's your sense of how much they are ongoing when it comes with partners like Taiwan, like Switzerland, who you just mentioned?
I think they are ongoing. And they even say that in this readout, they will still engage with a number of countries that they are dealing with right now, that they had a number of these trade talks. I was in Switzerland, though, in June. And what I heard from the top trade negotiator was they were given assurances by Secretary Besson and Ambassador Jamieson Greer, who will be joining us this morning, that as long as they were still talking in good faith negotiations, they wouldn't snap back to that April 2nd tariff rate. And it looks like today they are.
And even then some. And markets are having a little bit of a digestion issue. Danny Berger joining us this morning. John's off. And I have to say, I look at what's happening in equities this morning. How much of this is nervousness about the tariffs and how much is this just a top blowing off after pretty blockbuster types of results?
And how much of it is Amazon disappointment and this narrative that tech can keep spending and we're going to just keep cheering the CapEx, that is now seriously being challenged. I think it is all of the above, but it is a serious reappraisal this morning of if that spend can continue and if that's a good thing for these companies. If they aren't showing up and showing a real return on their AI investment, are we really going to allow them to spend that way? But if there is a pause in spending from the likes of Amazon because they're being punished, do they then fall behind? It turns into a really complicated narrative for them.
Being punished for not beating enough. And that, I think, is something that we'll have to come back to. Also, just adding to the deluge, the fire hose of different story narratives this morning. We also have a jobs report. Otherwise, we would have come in and it would be Jobs Friday as we get the non-farm payrolls report for the month of July. And Danny, this to me is going to be really key after a real question of how much the Fed is really going to be able to cut rates at all this year, let alone twice.
The onus is on the next 2 months of data because we had a Fed that did not move, because we had a Fed that cracks are now appearing. Very logical people can look at the labor market data we've gotten at this point and come up with two completely different narratives. On one side, it is a resilient economy and it is a labor market that is strong. On the other side of thing, it is real cracks that are showing. It's real concern about things like AI replacing jobs. It's a labor force that has declined a lot in participation. And are we going to see a supply shock? It is two very different outcomes with very different consequences for policy.
And with Jay Powell basically telling us this week, the main number he is looking at is the unemployment rate. So how important is that going to be when it comes to the markets and they're trying to basically price in when the first rate cut is going to be? 2 CPIs, 2 job reports before the next Fed meeting, and the president is expecting a September rate cut.
Got all that? A real slow summer. In markets, you can see just a little bit of digestion issues with equities near futures near their session lows as we head to the open. 1% decline ahead of the open for the S&P. The dollar is on track, or just had its best performance, its biggest strengthening going back to 2022 for the month of July. You could see yields just creeping a little bit higher ahead of that jobs report. Right now, coming up this hour, Sebastien of T. Rowe Price's new tariff rates send stocks lower. Tom Forte of Maxim Group on the diverging outlooks from Apple and Amazon, and Michael Pugliese of Wells Fargo looking ahead to that payrolls report. We begin this hour with our top story, President Trump announcing sweeping new global tariff rate hikes. Bloomberg's Brendan Murray joins us now for more. Brendan, what's the latest, and what's the latest on how fungible some of these rates still are?
Yeah, it's this. I think what we're seeing now are the more clearly are the broad contours of President Trump's America First trade agenda. We've seen, if you compare them to the April 2nd reciprocal tariffs that he announced, they've come down a fair bit. We've got a two-tier baseline system. Essentially, you have about 70 countries with this base of 15% and going up to 41%, and then you have everybody else who gets 10%. So you're looking at you're looking at more assurance, but not exactly a system that's designed for an efficient way to look at how global trade is going to be conducted when you have all of these various tariff lines. It's going to be difficult for businesses to sort out. We're in the heart of the shipping season right now, so you're heaping this on the logistics industry. So it's going to be, and I agree with Annmarie. Some of these rates that like Switzerland got and India received, those deals didn't get over the line. You could throw Taiwan in there as well. They're at 20%. They thought they were going to get a deal. They're an important semiconductor exporter. So these next 7 days, I think you're going to see some deal making still to be made if they can get it before these rates kick in on August 7th.
So August 1st, the deadline. August 7th, kind of the new deadline. Bloomberg's Brendan Murray, thank you so much for being with us. We'll catch up with you later this morning. Here's a view on Wall Street. Sebastien of T. Rowe Price rating. I'm bullish on macro and fundamentals, but cautious about valuations and sentiment. Optimism is priced in. Sebastien, I am so glad to say, joins us this morning. Happy Friday, I guess. It's quite a deluge. What a week indeed. What a day. I wonder how much what we're seeing in markets right now is because of high valuations where we've been versus tariffs and some speculation about what that could mean for economic growth.
Yeah, I was thinking about this earnings season, and as a philosophical question, is it still a surprise if everybody expects a surprise? You know, coming in earnings season, everybody was saying the earnings are going to be good. So you're seeing some of that unfold. I like to say a wise person once told me that happiness equals reality minus expectations. So look, stock prices are up 30%, Lisa, in 3.5 months. The price earnings ratio is at 22. Meme stocks are back. Crypto's rallying. That's what I'm worried about. I'm not worried about the fundamentals so much.
So this feels more like a top blow-off to you than it does a real assessment of some sort of greater pain as a result of policy. Is that correct? Do you think that we are overestimating the ramifications of tariffs on both corporate profitability as well as growth?
You know, just listening to the opening of the show today, it just makes it look like tariffs drive the entire U.S. economy. Right? We talk as if tariffs drive the entire U.S. economy. They don't. Goods subject to tariffs represent 9% of GDP. So there's a 91% of GDP that matters. I don't want to minimize the impact, but tariffs don't drive the entire U.S. economy. The consumer is doing just fine. Hey, we have fiscal spending that in our minds is going to be stimulative. And look, you have strong earnings. You know, we could get another 10% earnings growth for the next 12 months. We just had Q1, 13% year over year. The beat rate right now on sales this quarter is 80%. The 10-year average is 64. So there's more to the economy and markets than tariffs. I know it doesn't sound like that this morning.
Has Trump conditioned the markets, though, to digest a higher tariff rate?
Yes. Look, you can see it in April. An analyst sent me a chart of a trade uncertainty index, and he overlaid the S&P 500. And it was just the entire market was trading on the trade uncertainty index. You could get all that data on
So
Bloomberg.
The uncertainty is actually worse than the policy.
I think this is what was going on in April, right? When the market crashed and then recovered. Right now, the market is becoming more desensitized to tariffs. And to me, that makes sense. I just go back to the bottom line. I do think that the fundamentals are strong enough to sustain earnings growth. But at the same time, look, last week in our asset allocation committee, the B word came up, and it's starting to come up on your show as well, the bubble word. Now, no one on our committee thinks that we're about to pop a bubble, but we're discussing questions as to whether are we in the run-up to a bubble. And you have all these little signs that are starting to show.
And that maybe makes us more vulnerable to accidents. I was speaking with Julian Emanuel of Evercore earlier this week, who pointed to what happened in copper as an example of this. A VAR shock happens because we're unprepared for tariff changes on copper. Given how high asset prices are, even if the economy are not tariffs and tariffs are not the economy, are we now more vulnerable to announcements that might cause fissures we didn't expect?
Danny, I think that's the word, is vulnerable. With a price-earnings ratio of 22. By the way, it's not a good timing indicator, but if you look at, what the tail risk looks like historically when the price-earnings ratios are higher than 20, you do see a higher probability of a meltdown. You also have a higher probability of a melt up, which is interesting. In fact, if you look at stocks, how they do when you're at an all-time high for the next 12 months, they average like 10%. It's really not bad, but the tails, the extreme events, melt up, melt down, are much fatter. The probabilities are higher than usual.
Well, I guess kind of the irony is if it is a bubble that's growing, the best thing you can typically do in those periods is go long. So is that what you would be doing right now, Sebastien?
So we're weighing the fundamentals against those rising valuations, and we end up at neutral between stocks and bonds, but we're long diversification. So markets are showing historically high levels of concentration. We're a little bit worried about that. And we're short duration, short interest rate sensitivity, positioned for potential upside surprises on inflation. We've been running really low month over month on inflation for the last 4 or 5 months. But the one-year swap that the traders are pricing in, it's at 3.5.
So are you leaning into the American exceptionalism story or leaning out? Because it seems like the rest of the market is leaning in, and you're suggesting maybe it's time to look the other way.
Look, long term, we're leaning in. It's just fundamentally, it's a more dynamic economy. But as a tactical trade right now, we're looking at international value. We are long international value in small and mid cap. A couple of weeks ago, I had an analyst show me a relative valuation dashboard between the Russell 3, so the entire U.S. stock market, and the rest of the world. And I was convinced the numbers were wrong because the margins were higher outside the U.S. than in the U.S. It was 20 versus 15. The earnings growth was higher outside the U.S. and the ROE was higher, 13 versus 8. So I was getting ready to yell at the analysts. I never yell at analysts, but the numbers, Lisa, the numbers were technically correct. He was just showing me median numbers, not weighted average numbers. So there are plenty of stocks in the small and mid and value sectors outside the U.S. that have lower valuation, say 14, 15 range versus 19, and that have better fundamentals. So that's what we're playing right now. And there's momentum in that trade as well.
Sebastien Page, wonderful to see you, even as you rage at your analyst. Sebastien Page of T. Rowe Price. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hey, Lisa. President Trump unleashed his latest round of tariff announcements just hours before his August 1st deadline. Most countries are facing a baseline 10% tariff rate, but Trump slapped 35% tariffs on Canadian goods not covered under the USMCA. The new tariffs will take effect August 7th to give US Customs and Border Protection time to prepare. Elsewhere, Apple shares are trading higher in the pre-market, the company reporting its fastest quarterly revenue growth in more than 3 years, with revenue rising 9.6% to $94 billion. Strong iPhone sales and a rebound in China helped beat estimates despite a projected tariff hit. And shares in Amazon are falling in the pre-market. The online retail giant projecting weaker than expected operating income. It's also trailing the sales growth of its cloud rivals, leaving investors wondering whether its huge investments in AI are actually paying off. CEO Andy Jassy said it's very early days in AI and that the company's efforts to lower the costs will draw more customers over time. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Coming up next, we're going to be talking about reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Scott Lincicome of the Cato Institute coming up next. And later, we will be catching up with U.S. Trade Representative Jamieson Greer. This is Bloomberg. A softer tone to end the week. 3 days of losses if this holds. Right now, we're seeing futures near session lows. Welcome back as we do parse through a slew of information. NASDAQ futures down 1.1%. Russell 2000 really interesting this week, down 1.5% this morning in futures, just simply as we gauge what exactly the strength in the economy is. What kind of hit could come from this? Under surveillance this morning, reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. This is making our country very rich and respected again. 1 year ago, we were a dead country. Now we're the hottest country in the world. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Here's the latest. President Trump announcing a slew of new tariffs set to take effect on August 7th. Bloomberg's Jack Fitzpatrick joins us now from Washington. Jack, some of the highlights, how much of this is part of an ongoing negotiation?
It seems like that's a significant aspect in this. When you look at some specific anecdotal points on what came out yesterday, it does seem that there's evidence that, there's criticism that some of these numbers are arbitrary. I'd say it points more toward the political strategy of Donald Trump and the geopolitical strategy of Donald Trump. When you look at particularly high numbers for some goods from Canada, where he was frustrated about the flow of fentanyl over the northern border, the high rates for India, the high rates for South Africa and Brazil. It's not just a static moment where the president sets rates and says, on the merits, these are absolutely my numbers. President Trump likes to be the person who people come to seeking a deal. So while this is a big step toward understanding where he places countries and where he wants the tariff rates, it does not seem like we're anywhere close to the end of negotiations with plenty of countries around the world, because that's the way President Trump works.
Jack Fitzpatrick, thank you so much for that. Bloomberg's Jack Fitzpatrick will be joining us later in the hour. Joining us now is Scott Lincicome of the Cato Institute. Scott, we got a lot of numbers overnight. We're still parsing through them. We're still trying to figure out how many of them are actually going to stick. When clients call you up this morning, what are you going to tell them?
That I don't know the answer to when it's all going to end. And I think that's the problem. If you have perpetual negotiations, uncertainty prevails, regardless of what the numbers on the paper say. As of today, we now have dozens of new tariff rates. But as just mentioned, maybe those are just negotiating positions. Maybe they're going to change within the next week. But then maybe they change again in the next month. And that's a really, really difficult environment for globally connected companies, multinational supply chains, and particularly small businesses with one supplier trying to figure out their orders for next year. That's a really tough spot to be in. And so I think the continuing narrative throughout the fall is going to be trade policy uncertainty. And, of course, much higher U.S. tariffs on average than we've seen in 100 years.
Scott, when you look at the markets, though, it does look like they view these next 7 days as negotiations to be ongoing with a number of trading partners. Is that what you are telling clients? Because the market certainly thinks so.
Well, I certainly think that in the case of a few of these countries where there were reports that deals were very close, Switzerland, I think, being a good example, I think there is the chance that those are going to change in the next few days and that these rather absurdly high tariffs are going to come down a little bit. But at the same time, that's good for markets. It doesn't do a lot for the actual businesses operating in these environments. costs. You are not, taking comfort that maybe the rate's going to change when you're trying to plan a business. And so, and at the end of the day, going from 39% to 25% is cold comfort for a business that's going to be eating that cost or trying to figure out if they can pass it on to their customers here in the United States.
We still have federal courts, though, deciding whether or not these emergency tariffs using IEEPA are even legal. What happens if the courts say this is all illegal?
Yeah, that's the other big uncertainty issue right now. These trade deals are all under the International Emergency Economic Powers Act, which is being litigated at the federal circuit and elsewhere in the United States right now. Oral arguments yesterday went very well for the plaintiffs, meaning that they're optimistic this law or the tariffs themselves could be shot down. If the Supreme Court agrees with that on an expedited basis, all of this stuff could go away this fall. And importantly, all the trillions of dollars that President Trump brags about coming into the government might need to be refunded to importers over the months that follow. So a lot of uncertainty there, too.
A lot of uncertainty just everywhere, Scott. Also in the executive order last night, it made clear that this is a White House that plans on continuous monitoring of the trade partners for any violations. What is your understanding, Taz, what the bar would even be for a violation and what the reaction might be from the White House if it deems it so?
Yeah, and I think that's the other big story of the fall is compliance, because you're now talking about, we went from a U.S. trade system that was really simple. There was one rate for most of the world. You didn't care exactly where a product came from or what it contained. And now you have dozens of tariff rates for dozens of different countries. You have to worry about the metals content. You have to worry about it as Chinese content. And if you mess that up, you might be getting a call from the Department of Justice or the Customs Department, or if you're a country and your trade balance doesn't suddenly change, you might be back negotiating with an angry President Trump and a higher tariff rate. So all of those compliance issues, those are another cost for business, and it's another thing governments are going to have to deal with for the next long while.
Well, it speaks to things like the transshipment of understanding how many parts come from China and whether that's changed. Scott, do we even have the tools? Does global business have the tools to accurately track and analyze where these different products are coming from and what rates will apply to them?
Well, yes and no. So simple products, yes, you can track those things. You only have one supplier. It only has a few parts. But really complex things like aircraft and autos and where there are 3 tiers of suppliers, thousands of different companies in the supply chain from all over the world, accurately tracking that stuff, accurately determining the aluminum content or how much comes from China, particularly given how much intermediate goods China exports to the world. That's a Herculean effort. Something I did back in my old job for pretty simple products like washing machines. And even that was pretty darn difficult. Doing this for complex manufacturers, man, good luck.
Just real quick, Scott, why do you think a lot of market participants are shrugging this off as less relevant than they might have believed it on April 2nd?
Yeah, I think 2 things are, one, expectations. A lot of this is now baked in. Back in April, I just don't think many big investors thought we would ever get these big global reciprocal tariffs. So part of the shock in April was simply a big surprise. That's now been baked in. But the other big thing is we always have to remember the United States is a massive $30 trillion services economy, mainly driven by companies that aren't directly affected by goods imports. So you can do a lot of damage in the goods import sector without causing the S&P to crash or whatever. Now, that doesn't mean it's not going to be painful for a lot of companies, and particularly smaller ones. But it doesn't mean that you're going to have a crash or even a recession. It just means you're going to grow a little slower. You're going to be a little poorer. Prices are going to be a little higher. So that's not good, but it doesn't mean Armageddon.
Scott Lincicome of the Cato Institute, thank you so much for being with us this morning. Have a great weekend. And there is this feeling that a lot of people are looking to the underlying strength of the economy, Danny, and that's the reason why the jobs report becomes so important.
Right. And if there already are cracks and maybe lay on top of that some of the tariffness, does it become something that the Fed needs to deal with? And then the whole conversation changes.
Did you just say tariffness?
Tariffness, sorry. I invented a new word. It's a Friday.
Fantastic.
Why not?
I'm sorry. I like that. It's sort of this new adjective. Coming up, Tom Forte of Maxim Group on a tale of 2 earnings reports from big tech. 2 hours away from the jobs report, stocks taking a little bit of a breather after seeing, for the NASDAQ in particular, 14 record highs in the month of July. Today, the NASDAQ futures are lower by 1.1%. S&P futures near session lows, around that 1% decline. Russell 2000 actually taking it a little bit more on the chin, the 1-2 punch from possibly disproportionate damage from the tariffs that have been announced, as well as the Fed and what the Fed does after they get those data at 8:30 a.m. Eastern. Meanwhile, when you take a look at the bond space, you do see yields just creeping a little bit higher the long end. Yesterday, it did seem like we got better than expected data on the jobs front. Jobless claims came in better than expected. We also saw a little bit of resilient inflationary pressure, all focused very much on what happens in 2 hours. 30-year yields have bled higher over the past month by almost 20 basis points, 4.93%. And if you bleed it through the currency space, this to me is really compelling. The best month for the dollar going back to 2022. How much is a pain trade? How much is something continuing? Today, we are seeing ongoing dollar strength, but just marginally, 114 on the euro versus the dollar. 3 hours from the cash open, here are your morning movers with Danny Berger around the desk with us. Danny, what you looking at?
Well, it has to be big tech, right? Apple is the one that's doing better this session, not by a huge amount, 1.7% in the pre-market. Its fastest quarterly revenue growth in more than 3 years, easily tops estimates, also outperforms in China, a real bright spot. A lot of positivity on the call about AI improvements and lack of pull forward because of tariffs. Meanwhile, Amazon to the downside, basically just not growing as fast enough as its rival. Sure, you can beat, but if you're not putting up numbers near 40% for your cloud growth, like we saw from Microsoft, this is what happens. Just a 17% growth for AWS, leaving investors saying, hey, is it worth it, the big spend you're doing? Meanwhile, Coinbase down 11%, weaker trading volumes. There was a drop in volatility for crypto, if you can believe it. So that's why those earnings suffered, down 11%.
Yeah, when it's just off and to the right, you just don't have that much volatility. It's just one direction. On our radar this morning, we will be getting more back to the tech story. But President Trump announcing sweeping new tariff rates on dozens of U.S. trading partners. The tariffs range from a 10% baseline to as high as 41%. The move raising the average tariff rate to over 15%, which is 6 times higher than a year ago, raising questions on, will this stick, Annmarie?
That's the big question. Are these going to stick for countries like India, for countries like Switzerland, for countries like Taiwan, which all these trading partners were in negotiations with Secretary Besant, Commerce Secretary Howard Lutnick, and Ambassador Greer, who we're going to be speaking with. And the fact that they gave this wiggle room of 7 days, now the new deadline potentially for some of these countries is August 7th, is the final moments potentially of concessions we are going to see from some of these countries. And when you look at concessions we've already seen, remember when the European Union was ready to sign a deal at 10%? Well, then Trump was able to get 15% in terms of the baseline tariff when it comes to the EU. Is he trying to do that sort of negotiation with a number of these countries?
There was another story yesterday, and you hinted at this in our conversation with Scott Lincicome about the appeals court, the federal court, a panel of 11 judges that heard arguments from the government about the legality of using IEEPA in order to execute this type of tariff rate. And there was massive skepticism by those judges. How realistic is it that this gets overturned entirely and kind of upsets the apple cart when it comes to these negotiations?
Well, potentially, because legal experts are talking about how this is the purview when it comes to IEEPA for Congress, not the executive branch. The other thing I would note, though, even if the courts come down and say you cannot use IEEPA, when you're looking at a bunch of these tariff rates, the president still has, under his discretion, using USTR or the Commerce Department, a host of different orders he can do, whether it's a 232 sectoral tariff, to go after some of these countries and trading partners. So even if IEEPA, they were to come out and say this is illegal, there are other ways the president can enact his tariff agenda.
Meanwhile, global credit spreads tightening to their lowest level since 2007. Add that to some of the record highs that we've seen in big tech. Strategists at Goldman Sachs urging caution and warning against complacency. They were talking about credit spreads, but you see this from Michael Hartnett, also from Bank of America, saying that there could be a bubble, particularly in big tech, with valuations having risen so far.
But part of what that's done is created this really interesting market dynamic. I mean, IG corporate bonds have had higher total returns and lower volatility than treasuries. You look at something like a Microsoft, it's now rated more highly than U.S. government debt and has a huge cash output. It's making a lot of people really question long-held assumptions about what's a safe asset. But when you do that, you pile into some of these assets, you pile into credit. And again, as Sebastien was saying from T. Rowe Price, does that make you more vulnerable to shocks? The fundamentals can be okay, but if something upsets you, are you just ill-positioned for that?
And, to that point, there was a really compelling story about TSMC, the Taiwan Semiconductor Manufacturing Company, and that the ADRs in the United States are trading at an unprecedented premium at a higher level than what you see in the mainland of Taiwan. And how much of this is because in the United States, its tariffs are on the sidelines, it's big tech to the moon, and that's what you see in the valuations.
It's what you see in the valuations, but then what happens when you get someone like an Amazon this morning who disappoints, again, beats but disappoints, if that can be a thing? The bar still is really high to meet some of these prices that are being traded right now.
Yeah, we're going to get to the big tech story in just 1 second. Just crossing moments ago, President Trump truthing this morning about Jerome Powell, saying this: Jerome too late Powell, a stubborn moron, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everyone knows has to be done. So continuing that jawboning of the Fed official coming right before we get jobs numbers. He's seen the number. How much does this sort of indicate something going forward?
What stands out for me here is the line, the board should assume control. It comes after, for the first time more than 3 decades, we have these double dissenters at the Fed coming out and saying, actually, we see the economy different than the chair sees, and we think there should be cuts immediately. And of course, I'm talking about Michelle Bowman and Christopher Waller. So I think that is what's interesting now. The president is, once again, yes, attacking the chair, but he's recognizing that it is a deliberative body, and now he's calling into question the board, saying the board should assume control. I mean, everyone gets a vote, but basically putting more pressure, I think, on other members of the FOMC.
Yeah, and hearing from Scott Bessent yesterday that they do plan on announcing someone later this year in terms of a possible replacement to Fed Chair Jay Powell. Watch the space. We'll talk about it more coming up. But back to earnings. Apple reporting its best quarter in over 3 years as iPhone demand picked up worldwide, including in China. Amazon shares, meanwhile, falling after reporting the tech giant underwhelming cloud growth. Joining us now is Tom Forte of the Maxim Group. Tom, how bad really was Amazon versus just not absolutely moonshot, blowing out expectations like some of the other tech giants?
Yeah, so I definitely think that Amazon was a victim of expectations. Had the company reported before Microsoft instead of after, we might be talking differently without downplaying investor concerns about the competitive landscape in cloud computing and artificial intelligence. But I do see the market's reaction to Amazon as more a reflection of high expectations than poor performance. Sales and profits were better for the quarter, and if you look at the ranges for the outlook for next quarter, they were better as well.
So, Tom, before we get to Apple, there is this issue of what the constraint is for Amazon's AWS, their cloud computing unit, which has really been their main profitability driver. Is it just capacity? Is it that they can't build out quickly enough to meet demand? Or is it that they are losing share, that they don't have the same kind of AI advancement that, say, the Googles and the Microsofts have?
Yeah, so I would argue that it's more about capacity. So Microsoft is working closely with OpenAI. Amazon's working closely with Anthropic. Amazon is the market leader as far as market share. Google, to their credit, and Microsoft, to its credit, are growing at faster rates off smaller bases. But I would argue that of those choices, it's more about capacity than necessary market share.
Tom, how do you understand whether we reward these companies or punish them for the capital expenditures that they're doing? Is there a hint of that in Amazon, that they're spending too much to justify what isn't as strong growth as the other Mag 7 and big hyperscalers?
Yeah, so I think the beauty of Andy Jassy as CEO versus Jeff Bezos is Andy's found a way for the company to continue to generate strong profits and free cash flow and invest. So I think that if we were talking about a Jeff Bezos-led Amazon, there would be kind of ebbs and flows of investment spending. Andy has figured out a way to unlock sustained profitability, even with heightened investment. And I think Amazon, both under Bezos and under Jassy, has investors' trust that the investments will ultimately pay off, including for artificial intelligence.
And then there was Apple, Tom. And one of the more interesting things that Tim Cook said on the call was that he thinks only 1 percentage point of the 10% growth in revenue was due to a pull forward effect. Tom, is that even measurable? How much faith do you put in that number?
Yeah, so if they looked at their sales trends in April as it pertained to iPhones and Macs and discerned that consumers hearing all the chatter on tariffs bought ahead of concerns that tariffs would raise the prices of those products. And as you pointed out, it contributed to about 100 basis points of growth on a 10 percentage point growth. So I think that pull forward was a factor. The concerning thing to me in Apple's results is that they're acknowledging that they're behind on artificial intelligence. The good news is they're taking action. They're raising their CapEx, which is much more modest versus Amazon. And they even hinted at strategic M&A, which I thought was highly unusual for Apple.
Is it a little too late, though, when it comes to what Apple's doing in terms of AI, given the fact that we see Meta basically go in, take their top talent, and leave Apple still struggling?
Yeah, I don't know that I would say it's too late. It's definitely late. So the good news is now we know that we should expect an elevated Siri next year enhanced by artificial intelligence. That was a question mark even into the developers conference recently. I think Apple has shown a consistent ability to play catch up. They're not always first, but they're best. Maybe they won't be the best in AI, but certainly they could be better than what they are today.
Does this show you the fact that Apple is saying that potentially it's going to have to look elsewhere for AI, that they're just changing their strategy for a company that we know loves to build in-house?
I think they're saying that everything's on the table. So I don't think they're saying, hey, we're going to lean into strategic M&A unlike we've done in the past. I think that they're going to pull every lever they can to materially enhance the artificial intelligence experience on their products. That's how I view that statement.
Tom, Forte, this past week has been about American exceptionalism driven by big tech, and we've certainly seen some blockbuster results. We're quibbling with the details about Amazon, but still a pretty solid set of numbers. And I just wonder, when you have the likes of Michael Hartnett over at Bank of America talking about a bubble in tech stocks, an evaluation that just seems to have gotten over the skis, even of all of the optimism that you saw in the earnings, what's your response?
Yeah, so if you looked at the peer set for Apple, the PE went to about 35 times from closer to 28 times between last quarter and this quarter. So I think there's a lot of high expectations in big tech that they're going to land the plane, or however you want to think about it, when it comes to both tariffs, AI investment, and getting a return on that AI investment. So as a longtime follower of the industry going back to 96, having survived the dot-com bubble, I do think that there's a lot of high expectations, and it's reflected in the big PE multiples you're seeing in big tech.
Tom Forte of Maxim Group, thank you so much for that. Really appreciate your insights. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Let's head over to London with Lizzie Burden. Lizzie.
Hi, Lisa. President Trump is escalating his campaign to pressure pharmaceutical companies to lower drug prices. In letters sent to the world's 17 largest drug makers, Trump insisted that the companies immediately lower what they charge Medicaid for existing drugs. He also asked them to guarantee that future medicines be launched and remain at prices on par with what they cost overseas. Elsewhere, Chevron delivered better than expected results and raised its cash flow outlook after boosting oil production to a record. Adjusted second quarter profit came in at $1.77 a share. That's 6 cents higher than the median forecast. However, the company warned that crude prices are in danger of falling this year due to supply increases from OPEC and its allies. And billionaire Elon Musk donated over $45 billion to his super PAC in the first 6 months of this year. The new donations put Musk among the top political donors in the US. The filings show that despite his public feud with President Donald Trump, he continued to give to super PACs, benefiting Republican majorities both in the House and the Senate. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, we'll be counting you down to the payrolls report.
If you look at the bigger picture data, the best indicators of the balance between supply and demand in the labor market are the unemployment rate and the vacancies to unemployed workers. And both of those have been flat for a year, even though job growth has been somewhat tepid.
Michael Pugliese of Wells Fargo joining us next as we do count you down to that payrolls report at a time where we found out from this week that Jay Powell looks at the unemployment rate as the most important economic indicator. This is Bloomberg Surveillance. 1 hour and 43 minutes until the jobs report. Right now in markets, a little bit of softness in futures as we look to some of those earnings reports. In question, just have elevations gotten a little high, particularly in the big tech sphere. S&P futures lower by 1.1% near session lows as we blow off a pretty darn good week and month ahead. Meanwhile, people looking at what's going on in the currency space, dollar experiencing its biggest 1 month rally going back to 2022, building on that just a touch today, 114 versus the euro, and yields just climbing a touch ahead of that payrolls report, with a real question about just how much strength it will show given the data that we've gotten so far this week. Under surveillance this morning, counting down to that jobs report.
Job growth is slowing down. If you look at the bigger picture data, the best indicators of the balance between supply and demand in the labor market are the unemployment rate and the vacancies to unemployed workers. And both of those have been flat for a year, even though job growth has been somewhat tepid. You could see a bigger slowdown starting even in the next jobs report.
Here's the latest. Investors counting down to July payrolls in less than 2 hours' time. Bloomberg survey median estimate coming in at 104,000. Michael Pugliese of Wells Fargo joining us now. And before we get to the jobs estimates, I wanted to gauge your opinion of how much weakness there really is under the hood. We got another Truth Social post from President Trump this morning where he called on Fed officials to overrule Jerome Powell, saying that too late, Powell, a stubborn moron, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everyone knows has to be done. Michael, I'm just wondering, do you think that this economy requires a rate cut based on some of the cracks that some people have pointed to in the labor market?
Well, good morning. And no, I don't think so. I don't think the Fed is there yet. When you look at the labor market data, there's certainly some stuff to be concerned about, right? The breadth of hiring has been pretty narrow over the past few months. Consumer sentiment on the labor market, when you look at things like the percent of people saying jobs are plentiful versus jobs are hard to get, has deteriorated. But generally speaking, I think that there are a lot of signs the labor market has stabilized this year. The unemployment rate was 4.1% in December. It's 4.1% today. You look at jobless claims, JOLTS, ECI, all of them pointing to, I think, some stabilization in the labor market. And meanwhile, on the inflation side, you're sitting at 2.8% on the core PCE deflator, probably some upside risk from here because of the tariffs. And so, no, I think there's a case to be made that the Fed needs to be nimble going forward and ready to cut rates in case there's a deterioration in today's data or in future months, but probably not yet. I don't think it was necessary at this meeting.
Yesterday, David Seif of Nomura was on with John and Lisa, and he was talking about now that we have these two dissenters, a more willingness to see governors dissent on the board, it's going to bring an end of decades of de facto Fed dictatorship by the chair. Do you agree with that? Are we potentially entering a more deliberative and debate amongst the Fed when it comes to rate decision and monetary policy?
No, I don't think so. I mean, I think the chair is, of course, the most important member of the FOMC. They're always going to carry the most weight. But, as I've watched Chair Powell over the past 7 years, I think consensus building has been one of his greatest skills when it comes to trying to trade off between board members, regional Fed presidents who at different points in the cycle have had different opinions. And we've seen that many times back to 2018, 2019, when the Fed was under some pressure to cut rates, during the pandemic, the initial takeoff, last fall's cuts. And I think the chair's job in some ways is trying to build that consensus across 19 different members who all have very different views sometimes, particularly when you're at a key inflection point in monetary policy or in a moment like now where the dual mandate is a little bit in tension between downside risk to labor market and upside risk to inflation.
Well, Chair Powell told us what he's looking at today. He said the main number you have to look at right now is the unemployment rate. If that's the determinant of monetary policy, what in the data is he seeing that he thinks that's the main number we should all have our eyes peeled at 8:30?
Right. So when you think about the employment report, traditionally you think of the NFP number, right, and you see that slowing down. That can be a worrisome sign. But what I think that the Fed, and I certainly agree with this, is trying to figure out right now is how much of a slowdown in non-farm payroll growth is because of a slowdown in labor supply. Obviously, as you've seen, a lot less immigration into the United States over the past 6 to 12 months. So to some extent, you would expect job growth to be slowing in 2025 because of that supply-demand dynamic, but that does not necessarily mean that demand and supply are getting out of balance. Whereas the unemployment rate, while not perfect in terms of measuring that, should come a lot closer to telling you how are labor supply and labor demand in balance. And so far, so good this year. And I think that's been corroborated by initial jobless claims, continuing claims, and some other data like that.
Hey, Michael, if I can just go back to one thing you said about Powell being the consensus builder, and we continue to see that. I'm kind of struggling to see where the consensus was in this last Fed report. He didn't really seem to include at all the two dissents into his viewpoint of going forward, even going so far as to say, hey, we are looking at tariffs. We are looking through tariffs because we're not talking about hiking. Is there a risk that there could be some real concerns, but it's being brushed off by the chair and many market participants as just political?
No, when I go back and listen to what Chair Powell was saying, he talked about downside risk to the labor market quite a bit, right? And in fact, it was a year ago, pretty much today, where the Fed had a very similar dynamic. They had not cut rates yet. They met in July. They decided to sit on hold. And then they got a couple weaker labor market readings. And what did they do? They reacted to that. And so if that's what happens, let's say today we get a much weaker reading, unemployment rate rises, we come back in a month, it tells a similar story, then it would not surprise me at all to see that nimbleness from Chair Powell and the rest of the committee who did not want to cut rates, to see them initiate a rate cut in September. I mean, bear in mind, the June SEP, which is now about 6 weeks old, it did still signal 2 rate cuts by the end of this year, but that was conditional on an unemployment rate rising to about 4.5% or so. And so if it stays flat, and I think that the median on the committee, at least my guess would be, they're not going to be quite there yet in the near future.
How much more difficult is it going to get to understand where this labor market is going, Michael? On one hand, you have the labor force participation. You have a shrinking force, but might be hard to gauge depending on just how robust some of these surveys are and people's willingness to answer the surveys. And on the other hand, you have things like the Challenger's job report talking about tech being the bulk of layoffs that we've seen. How difficult, with these big macro trends coming in, is it going to be to gauge a real shift in this labor market?
Yeah, it's really hard, right? I mean, that is just the challenge of economic data generally, even in good times, even when the economy is not volatile, even when there's not big policy challenges or issues with data collection. I mean, consider how in real time we're attempting to measure the total number of employment, the total amount of employment in the United States for July, and it's the morning of August 1st, right? I mean, that's very real-time data. And I think some of those challenges, what they do, it's not that it makes the data more accurate, less accurate. It just creates more volatility, more noise, a little more susceptibility to revisions. And I think what it requires is just trying to take the totality of the data, right? So for example, we talked about the unemployment rate. I think that's 1A today when thinking about it. But you want to look at other things. You want to look under the hood at the breadth of hiring. You want to look at the prime age employment population ratio. We want to look at jobless claims and JOLTS and all these data and try to take that totality of it and form an opinion on where are we at right now with this labor market in the cycle.
It's August 1st. I have to keep reminding myself that. Michael Pugliese of Wells Fargo, thank you so much. The totality of data has turned into a whisper number, I believe, of 120 and a range potentially of 0 to, 170?
I mean, really reasonable people can look at this market and come up with 2 different ideas of where we are. I have to say, a whisper number being a little bit more strong is something we haven't seen in a while. So I think it's this continued expectation that we are resilient, that the numbers will show up strong. Hopefully that won't break, but what happens if it does with stocks at all-time highs and credit spreads at the tightest since 2007?
Yeah, what does it mean to break? Coming up next, Priya Misra of JPMorgan, former senior White House trade advisor Kellyanne Shaw, Ares Management Chief Executive Officer Mike Arougheti, and Sarah Wolfe of Morgan Stanley as we count you down to that jobs report in a very busy morning.
We're in a bull market. I like the fact equal weight S&P is getting involved with tech.
Tech is helping the stock market quite a lot.
If you look at what's driving markets, the Mag 7 are driving about 1/3 of overall market action.
The market is pricing in some idea that you are going to get that broadening of the AI benefits.
Clearly, the companies that are succeeding in the markets today and seeing investor dollars flow into them are those that have a clear AI strategy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance and to the start of a new month, starting that new week with a new slew of tariff rates and possibly a new deadline, causing some turbulence in stocks that have already gotten to pretty high valuations ahead of a key labor figure coming out in 90 minutes time this morning. We are seeing a little bit of a softness in futures as markets churn ahead of that key payrolls report. You could see the weakness really accentuated in the Russell 2000, but also in big tech. NASDAQ futures lower by 1.3% after, I guess, a disappointment, maybe just not hurdling that high bar highly enough from the likes of Amazon. Meanwhile, in the bond space, a real sense that there is enough resilience in this labor market to prevent the Fed from cutting rates. You can see yields higher across the long end, front end a little bit softer as you do get job owning from the Fed, and you bleed this through what we're seeing in the currency space. It has been a rip-roaring month, the month of July, for the dollar, with the strongest performance going back to 2022. Sort of continuing that today, but just fluctuating there. The euro kind of going nowhere versus the dollar, 114. Meanwhile, what we're seeing today is this question of what is a deadline? Annmarie, is August 7th the new deadline?
Well, it's self-imposed, so deadlines can definitely move, especially if they're self-imposed. And we've seen this story before with the Trump administration with these deadlines. They are fluid. So now with this executive order coming out, this statement, I'm looking at the fact sheet now, they're saying that in 7 days, on August 7th, basically, that is when these rates you're seeing on your screen right now will come into place. And everyone's been talking about Switzerland because the rate now is even higher than it was on April 2nd. April 2nd was that shock and awe. The market seems to be digesting this a little bit more. But what we have in place is what the president promised on the campaign trail. 10% baseline tariff around the United States, 15% or higher on certain trading partners. Key is, in this fact sheet, several countries have agreed to or on the verge of agreeing to meaningful trade deals, which is why everyone thinks we are still in negotiating mode when it comes to this White House.
And Danny, I'm really struck by the fact that we are seeing some softness in equities, but it seems more attributed to just where we're coming from than, say, some of these announcements. And it raises this question, as we were talking to Sebastien Page, how much do tariffs actually affect stock valuations given how dependent this economy is on services?
Well, they affect you if you're Ford, but Ford is much smaller than, for example, an Amazon or a Microsoft. But the thing is so much of the confidence of this market had been built up around this idea that Trump chickens out. I don't know how we look at yesterday and still have that narrative and still have that idea that Trump is going to back off at things, because it is clear he is not. I think Terry Haynes put it well that this is not a trade war. It is war with trade being used as a tool. Trump is not afraid to put these tariffs on. Perhaps more what we're trading on is that other countries will chicken out. This idea that other people will back off and get us to a lower rate.
And potentially the other companies will struggle more with these tariff rates than the United States. And that's why it is important to look at the actual data coming out, and really highlights July's non-farm payrolls number, expected to be somewhere in and around 104,000, with a higher whisper number ahead of that. That's the reason why I found this Truth Social post so interesting from President Trump this morning, Annmarie, coming out and saying maybe the rest of the board should take control if too late Powell doesn't cut rates. It raises a question. If he has seen the data, does he not like said data?
Well, I think that's the question, right? If he's seen the jobs report, is it a bad number or a good number? He's saying the board should assume control and do what everyone knows has to be done. He's really leaning on the two dissenters we saw this week coming out. It already is a deliberative body. The board already agrees. But once again, not just John Boning, the Fed chair, but also leaning on other members of the FOMC to maybe come out, voice their concerns, and be a dissenter. This is going to be a very important payrolls report. Then we have one more, and then it's a September rate decision. And the president this week said, I hear they're going to cut rates in September. Well, will they? Depends on this data.
And we are expected to hear more from the dissenters in terms of just how much they are going to lean into potential weakness in the labor market. Coming up this hour, Priya Misra of JPMorgan, with stocks extending a 3-day losing streak. Former senior White House trade advisor Kellyanne Shaw with President Trump unveiling new global tariff rates, and Sarah Wolfe of Morgan Stanley counting down to payrolls. We begin this hour with stocks dropping as President Trump boosts global tariff rates and investors await U.S. payrolls. Priya Misra of JPMorgan writing this. I think risk assets are priced to perfection and vulnerable to any further slowdown. Priya joins us now. Priya, so good to see you. Thank you for being here. This kind of piggybacks on what we heard from Goldman Sachs, pointing to global credit spreads, their tightest going back to 2007. Do you think that this is overly complacent because there is weakness in the economy, or just because they have gone too far, too fast?
So I think there's an element of that valuation point. If you look at risk premiums across the board, interest rate vol, credit vol, equity vol, all extremely low. I think the view is the economy's been resilient so far. We're getting certainty. Now, I would argue the market might be a little complacent on certainty. We're still in that negotiation phase. We still don't know the sectoral tariffs. But I think there's hope that, well, we kind of know the tariffs and companies can adjust. And so the resilience stays. I think the soft landing is essentially what's priced in, and then the Fed's going to cut. Well, this all starts to shake a little bit if the economy slows down, but the Fed is nervous around the inflation risks. And that's what we heard from Chep out. I think the bar for them to cut has actually increased in the last few months. And if the market gets a whiff of that, you're not getting the rate cuts that you wanted. You might have that stagflation actually show up in the data. I think that's where risk assets, those risk premiums should rise. You know, I think credit spreads, you have to be really careful. High-grade companies, I think with very high, pretty high operating margins can absorb a lot of this. We just don't know how much will the margins compress versus how much do they pass on. And so I think, you have to do the research, and there's sectors we like. We still own credit spreads. We are, though, moving up in quality because I think some companies are going to struggle. They're going to struggle to pass it on. Then they're going to, that's going to hurt their margins. And then they're going to have to start laying off. That's when this thing becomes more than just soft landing and you start to worry about a slowdown. So far, the data has been okay, but I would argue we're operating under 10% effective tariff rate. Last night's announcement, what we've seen over the last few weeks, that's moving closer to a 20% number. And that's not a shock value of 20%. We've just sort of drifted to that 20% number with uncertainty, I think, still at a fairly high level. If that weighs on what companies are doing, what households are doing, I think that's what worries me, that we haven't seen the economic impact of that 20% effective tariff rate.
We've had more than one person on the show this morning saying we won't really see that much of impact, though, because this is a services-based economy, that goods matter less, that in an overall picture, the tariffs, something at 15%, isn't going to have an outsized impact. What would you say to that?
So I think there's some element to that, absolutely. And that's why business cycles have been longer as the world is effectively moving to a service economy. Here's the issue with that. If companies do try and pass on some of this, the tariffs, real disposable income starts to go down. So do I cut my service consumption because I'm going to have to pay more for the goods that I do need? Yes, my consumption basket's not 80% goods, but if I'm paying more for those goods, I'm going to cut back on services. Maybe I cut back on discretionary services. Just have to live somewhere and I have to pay rent. Do I cut back on vacation spending? So I do worry that the consumer, unless wages start to pick up, that's the key. So beyond the unemployment rate that we're absolutely going to watch today, I think more than the payroll number, it's that wages. We're seeing absolutely no signs of wage pressure. That would make me a little more comfortable that consumers may be able to continue to spend on services. But if wages continue to be around here, which is our sense from the quits rate, not just from the payroll report, but across the board, we're seeing a low hire, low fire market. I think in that case, consumers start to cut back on other things. There are already real personal consumption expenditures. The first half of this year, 1%. What was that number in the second half of last year? 3%. So there has been already a reduction. If that continues, I think then it's going to spill over. I'm not talking about a recession, but you have to worry about, does growth get closer to zero from that, sub-trend 1.5% to 2% rate? And I think that, in my mind, is not priced into risk assets. To our earlier discussion, it's also not priced into rates. So I think owning some duration here makes a lot of sense.
What would that look like if it was priced in? How should we be trading if we are to incorporate that?
So I think it depends on how much are we slowing. If you're just slowing to the unemployment rate at 4.5 or 5, the Fed can get close to neutral. Now, what is neutral? We need a lot more time to debate that. And I think there's a wide range of views, 3 to 3.5. So that's a 10-year closer to 4%. If you're telling me this is actually slowing to the point where the Fed has to get into accommodative territory, they're cutting what the president actually is asking for them to cut. I don't think we're getting there. But if the data supports it, at that point, you're looking at much further declines in rates. That is a tail risk scenario. It's not our base case. But we're thinking the 10-year should be closer to 4 or a little below 4 rather than this 4.5 level. So I think that's where you've got that value of hedge. We're not seeing that sell America trade. That was a big concern. I think the last time I was on, I was saying, I don't know about correlations. Correlations are back. The Fed's telling you they'll react. We know the reaction function. It's the economic outlook that's extremely uncertain.
The president says the board should assume control if Jay Powell won't cut rates. We know it's a deliberative body, but do you expect more dissenters?
You know, I think if the dual mandate gets more intention, so if you get the inflation numbers ticking up higher, as service inflation doesn't fully offset goods inflation, and the unemployment rate starts to rise, I think it's quite possible we get dissents, but I think it's not necessarily political. I think there's a narrative that the dissents were all political, that they're all just trying to audition for the next Fed chair. I think there's an economic debate here. That is the unemployment rate, if there's tension between the two, which side of the mandate do you give more importance to? So I would expect, yes, if the stagflationary shock, that 20% effective tariff rate is what we're living with, I think you'll see more dissents, unless the data tells the Fed clearly. If it's a slow grind to a rise in the unemployment rate and inflation picks up, I think you'll see more dissents for good reason. And that's what the Fed should be doing. It's a committee. They should debate it, and then maybe they start to cut but not commit to a cutting cycle, because they can just start the process and the end point might be more open.
What's the pain trade today after we get this data? If the data is too hot or if it's too cold?
I think the too cold, I don't know, because at that point the market might say, oh, the Fed's going to cut. What if you get a 50,000 on payrolls and a 4.2? The Fed's going to say, okay, the growth in jobs is slowing, but so is the labor supply. And that's worrying, because that means things are slowing down, but you're not getting those rate cuts. I suspect a lot more Truth Social posts on that, maybe more dissents. So that's one. And then inflation. You get a pickup in inflation in 2 weeks' time, that's another form of pain trade, where every market's going to say, okay, maybe now we're seeing the economic impacts of that 20% tariff rate.
I can guarantee that whatever happens, we will be getting more Truth Social posts. Priya Misra of JPMorgan, wonderful to get your thoughts. Thank you so much. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hey, Lisa. President Trump unleashed his latest round of tariff announcements just hours before his August 1st deadline. Most countries are facing a baseline 10% tariff rate, but Trump slapped 35% tariffs on Canadian goods not covered under the USMCA. The new tariffs will take effect August 7th to give US Customs and Border Protection time to prepare. Elsewhere, Exxon reporting second quarter earnings that beat analyst estimates. Robust oil production from the Permian Basin and Guyana cushioned the impact of lower crude prices. Exxon sees continued growth and plans to, quote, create value through acquisitions. And the end of an era. Ray Dalio has sold the last remaining stake of his in Bridgewater Associates and left the hedge fund's board. Dalio first announced his succession plan more than a decade ago, but didn't fully hand over the reins until 2022, when he transferred his voting rights to its board of directors and stepped down as one of its 3 co-chief investment officers. Dalio founded the firm back in 1975. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Joining us next will be former senior White House trade advisor Kellyanne Shaw to translate. And next hour, we'll be speaking with U.S. Trade Representative Jamieson Greer, fresh off navigating all of these trade conversations with some insight there. This is Bloomberg Surveillance. An hour and 14 minutes until that key payrolls report. Right now, we are still reeling from a slew of data, a slew of tariff numbers, and a slew of earnings reports from a number of big tech behemoths. All of that bled through the markets, and you could see futures softer, down 1% off some of the lows earlier this morning, S&P. Meanwhile, just kind of flat in the currency space. Euro dollar going nowhere, 114 after a blockbuster month. The biggest monthly gain for the dollar going back to 2022. Yields grinding just a touch higher as people try to parse through the inflationary ramifications plus potential pressure to cut rates. Under surveillance this morning, reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. This is making our country very rich and respected again. 1 year ago, we were a dead country. Now we're the hottest country in the world. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Here's the latest. President Trump revealing a new tariff rate set to take effect on August 7th, or rather many tariff rates. This boosting the average U.S. tariff rate to above 15%. Bloomberg's Jack Fitzpatrick joins us now from Washington. Jack, it's been tough to really understand all of the different rates. They're all over the map. What's the latest on what we know and how firm it is?
Well, we know it's not terribly firm, or at least that's how it's being interpreted. Already today, we've seen a comment from the president of Taiwan saying he thinks that 20% tariff rate is temporary. Understanding President Trump's approach to negotiations, it is fair to say that there are going to be more talks. There are going to be countries coming to him. He really prefers to have people coming to him seeking, if not handouts, a better deal than they've gotten. And of course, there were some surprises, some negative surprises when you look at the 39% rate for Switzerland that Swiss officials took as a surprisingly negative. So there is certainly an expectation that there will be more discussions. Overall, I'd add to that, if you're trying to suss out how much uncertainty there really is, the skeptical tone from the justices on an appeals court, a federal appeals court, about Trump's legal ability to do these tariffs with his emergency powers adds to the uncertainty. And of course, there's the China question with the current truce running through August 12th and then perhaps being extended. So there's a lot of information there. There's a whole table of tariff rates, but there's also plenty of uncertainty and an expectation that things could change going forward.
A new table and possibly a new timeline. Bloomberg's Jack Fitzpatrick, thank you so much for running through all of that with us. Joining us now is former senior White House trade advisor Kellyanne Shaw. Kellyanne, is the new deadline August 7th?
Good morning. Thanks so much for having me back on. I think the deadline is August 1st. Customs really needs about a 7-day period to try to effectuate some of these tariff rates, to update the HTS, to give notice to importers. Like, this buffer is actually just necessary for logistical reasons. But that said, there's no real deadline, meaning countries can come to the president and request to have a lower tariff rate either 3 days from now, 3 months from now, or 3 years from now. And the president has said that he's willing to talk and to see what can be done if countries are willing to either lower their tariff and non-tariff barriers or invest in the United States, which is another option that Japan proved is on the table.
Perpetual negotiation is what it sounds like. Kellyanne, I'm shocked by Switzerland. They had a 31% tariff rate designated April 2nd. Then during the reprieve, it was 10%. Now they were at 39% when I thought they were on a cusp of getting a deal. What is going on with this trading partner?
Yeah, the number one question I heard was what happened to Switzerland as soon as these rates came out. And to your point, there had been rumors of a deal that had basically been in hand. But the way that these negotiations had been unfolding is that USTR, Commerce, and Treasury were negotiating a package and then presenting them to the president for his final seal of approval. And in many cases, that involved him picking up the phone and talking to various world leaders to see, is this really your bottom line? And so it could be that the president had a similar conversation with his Swiss counterpart that didn't go particularly well. But when you look at that 39%, that's almost triple Switzerland's European cohort. Clearly something went off the rails. And I do expect that whatever beef between the U.S. and Switzerland may have unfolded, as soon as that de-escalates, we'll see that rate come down.
And this is a country that's in the top 5 when it comes to foreign direct investment in the United States. So for certain countries, are you viewing August 7th as potentially the new deadline for a country like Switzerland?
Well, again, I don't think that there's really a deadline here now. I do think that the Swiss are probably pretty panicked at the moment about this 39% tariff rate. So I would expect that we would see some progress potentially in the next couple of days on that deal. But there are a couple of other deals that the president hinted at yesterday in those comments. We haven't seen a deal with Taiwan. We haven't seen Thailand or Malaysia. There are other trading partners that have been in active negotiations. And so we could, between now and next week, see some of those deals announced and those tariff rates slightly adjusted.
Kellyanne, when this conversation first started earlier this year, one of the real concerns was that there would be retaliatory tariffs for various nations, or that various nations would try to band together to try to get something or some sort of concession from the U.S. That hasn't happened at all. What do you make of the lack of reaction from some of these trading partners and just more concessions?
Yeah, what's been really interesting is that we're talking about tariff rates somewhere between 10 and 25% on average that the U.S. is now imposing on all of its major trading partners. That is really a transformative way to manage the U.S. economy. We haven't seen tariff rates like this in almost 100 years. And so this idea of our trading partners just accepting those rates has been pretty interesting to watch. And you saw Ursula von der Leyen over the summit in Scotland this weekend saying that she accepted the president's premise that this relationship between the U.S. and the EU had been unbalanced, and that the EU was willing to then agree to this 15% tariff, and same for Japan and South Korea. So we haven't really seen the pushback we thought we might from some of our trading partners, which goes to show just how broken the global trading system was to begin with, where countries are actually falling in line with the president's vision of just higher tariffs from the U.S. side. It's pretty incredible to watch.
They fall in line, but how much of this just results in just a little bit of trading less with the U.S. and some of these global partners looking elsewhere?
Well, we'll have to see. And that's certainly the point that a lot of our significant trading partners are making, that if the U.S. is not open for business, we're going to go elsewhere. We'll go to China. We'll find other markets to diversify. But we'll have to actually see how this plays out. And even on the private sector side, for companies who've been waiting with bated breath for a bit more certainty on the tariff landscape, I think it's going to take several weeks to absorb and understand what these tariff rates really mean, how that impacts supply chains. And then again, for our trading partners, whether or not they want to continue doing business with the United States or not, I think we're going to see that play out over the next several weeks and several months. I don't think this is an overnight decision, but clearly there has been buy-in to the fact that the old way of doing trade didn't work. And so there is a search for a new path. And if this is it, the president will have hit it out of the park. If not, we'll see something else emerge over the next several months and years.
The advice a couple of weeks ago was to grab a beer and just wait. Right now, Kellyanne, what's your advice to corporate clients?
Yeah, I think the time for the beer may have come and gone. I think some of these tariff rates are going to be a bit stickier, just in terms of this global 10% to 15% baseline on most of our trading partners, with some elevated rates, 20% in Asia. And then there are some outliers, like we talked about with Switzerland and others, which we may see adjustments on. But I do think you can now start to see a bit of a clearing in the path in terms of what some of these tariff rates might look like. But the other side of the story we don't know about is what concessions our trading partners may have made. And for many of these trading relationships, it's not just the tariff levels that matter. It's these non-tariff barriers that can be the difference between doing business in an economy and not. And we haven't seen the text of these deals that have been announced, what concessions, again, may have been made. And I think we need a bit more certainty there before we're really going to see businesses moving in this new direction.
Former senior White House trade advisor Kellyanne Shaw, thank you so much, and have a wonderful weekend. Maybe not pounding beers, but pounding Red Bulls and Celsius.
Yeah, as long as those Celsiuses aren't high noons. What I was so struck by what Kellyanne Shaw said just there is the fact that these deadlines don't really matter. And the fact sheet basically says that. You can come to us with a new trading deal if you have one. So we could be talking about this for the next 3 months or the next 3 years.
What were we saying about certainty and whether we were getting any certainty? We'll be talking about that throughout the show. Coming up, though, don't miss this. A fantastic guest that we have, Ares Management Chief Executive Officer Michael Arougheti, on the shifting private capital landscape after reporting earnings. That's just ahead. Just 1 hour from the third biggest story of the day, evidently non-farm payrolls, at least for now, but it will become the main event as people try to understand exactly what ramifications that figure has on Fed policy. Right now, a bit of softness after earnings that disappointed from Amazon in particular. S&P futures lower by 1%. You could also say perhaps a little bit of a top blow off given such high valuations. Euro dollar not doing much of anything after a blockbuster month for the dollar, the strongest monthly gain going back to 2015. 2022. Yields creeping higher. 2 hours away from the cash open. The morning movers is where it's at. Danny, what are you looking at?
I'm looking at Eastman Chemical this morning. Chemical company is always interesting just because of their exposure to so many parts of the economy, down 12.5%. It reported yesterday it was a miss, basically saying it's the challenge of the macro environment, that there's caution because of the tariff landscape. Then there was Exxon. They reported this morning it was a beat, and there you see shares just under 1%. Yes, there were lower oil prices, but they offset some of that with robust oil production from the Permian Basin and Guyana. Finally, Figma, the IPO that has finally arrived, shares up 20%. They have surged 250% since they IPO'd. It values the design software firm at $56 billion, so maybe some hope that IPOs are returning this year.
Yeah, it's really interesting to see all the IPOs that have come out actually perform better than they have in previous years. There just haven't been that many of them, so it raises a question. Talking about that in just a bit. On our radar this morning, the top story, President Donald Trump unveiling new tariffs, boosting the average U.S. rate on goods across the world to 15.2%. The new tariffs take effect after midnight on August 7th. Don't miss our conversation with Jamieson Greer, the ambassador who's been really working through all of this, Annmarie.
Absolutely. He's at the negotiating table for all of these deals, and some of these deals that they didn't quite get to the end there, like Switzerland, like Taiwan, like India. And I think that's really where we want to focus on what happens in the next 6-7 days with these countries that their tariff rates have gone up, like Switzerland, since April 2nd, even though they've been in constant communication. And the Swiss trade representative told me in June negotiations were going well, and she was given reassurances by Besant, by Greer, that as long as they were in good faith, they would get an extension of the deadline. And clearly, they did not, unless August 7th is the new deadline.
Well, and then it also raises the question of when are negotiations finished? Or are they constantly ongoing? President Trump sending letters to 17 of the world's largest drug makers demanding they charge the U.S. what other countries pay for new medicines. The president giving the companies 60 days to voluntarily comply and threatening action if they don't. Those shares are falling across the board, although you could argue that those like Novo Nordisk have been hit by other things, like the disappointing performance of their weight loss drug. We'll get into that in a bit, but a tale of two tech earnings. We do want to talk about what we got last night. Apple reporting a strong revenue beat and a rebound in iPhone sales, saying, no, it's not just a bringing forward of demand. Meanwhile, Amazon's profit guidance and cloud growth falling short of street expectations. And this really raises the issue. How much, Danny, is there going to be a penalty for companies that are not effectively using spending that is just not mounting and mounting among the four tech behemoths?
But we still don't even know how effective that spending is at this moment. People have kind of been hailing Meta. Oh, look at Meta. It's such a great example. They spent a lot, and things like ads are getting better. More people are using Instagram. The problem is the type of AI they were using was kind of the older kind. It wasn't the generative AI that everybody's piling into. So you have this moment still where they are trying to one-up each other in terms of spend. And we still don't have exactly what the implications of that is going to be and what the use case is going to be. And I think in the Amazon earnings, you see the nervousness to make sure that it really shows up.
If you feel this year, like all of this has been a lot of just complicating noise, and you want to just take a look at what is actually going on the ground that doesn't really move as quickly and doesn't have the same kind of whipsaw from headlines that some of the public markets do, we've got to look at alternative asset management, which is really what so many different investment managers have been talking about. Is the alternative to this whipsaw head-spinning world that we've been talking about all morning. Ares Management, a global alternative investment manager with over $570 billion in assets under management, reporting second quarter earnings today, highlighting solid financing growth, momentum, and seeing the market come back to life. Joining us now, I'm so pleased to say, is Ares Management CEO Michael Arougheti. Thank you so much for being here with us. I want to start with this idea that you did a really solid performance, despite the fact that LBO volumes were materially lower than last year. And there's this expectation that deals were going to pick up in the second half because of trade certainty. Well, have we gotten that certainty to really kickstart that type of corporate activity?
Yeah, I think there's a misconception that alternative asset management is just driven solely by M&A and private equity volumes. But when you really zoom out and you say, what is going on in the private markets? We are active in digital infrastructure, real estate, private credit, asset-based finance, and really a broad cross-section of the global economy. So if you look at our quarter, we put $27 billion to work this quarter in a very subdued deal environment. What's happening now in the private markets is there's a huge need for liquidity solutions and refinancing. If you look at private equity as one example, there's about $3 trillion of private equity that's been invested that needs to get returned to investors, and about $1 trillion of new capital that needs to get put to work. So there's this huge imbalance. And so one of the things that private market providers like us are doing now is really coming in with creativity and innovative solutions to try to buy down that installed base of private equity. So we're not really reliant on deal volume. Obviously, we love it when the markets are ripping, but when they're not, it's still pretty good.
Does that mean that the lesson you learned from this period of when things are backlogged, and again, just given the breadth of the success in your earnings, that you need to de-emphasize some parts of the business that are more sensitive to M&A, that have more of a cyclical type of attribute to them?
I don't know if we want to de-emphasize. I think part of what we have tried to build is a business that provides solutions through cycles to our investee clients, whether they're private equity sponsors or large corporates, and our investor clients. And the only way that we could do that is to diversify the product set geographically, where we invest in the capital structure, what returns, what the structures are. So ideally, what you want to have is a business which we're demonstrating that can perform regardless of the market environment.
Well, part of the diversification was also things are uncertain in the U.S., to Lisa's point. Is that period over? Is certainty restored? Is it time to hit the go button again on deals?
You know, it's always great when I come on the show because you go to bed and you're like, oh, we're going to have this really nice, calm conversation about how certain things are and how deal volumes are going to pick up. And then we get a new headline. And as you said, Lisa, I think you have to try to find the signal through the noise. And when we look at our portfolios around the globe, fundamental performance is still really strong. There's a lot of liquidity in the markets. There is a lot of pent-up demand to transact. We saw that in June. I think once we got the tax bill done and we saw some certainty on tariffs, the market really picked up. So I don't want to say that one headline on one day is going to knock us off course, but yeah, I think there's a real pent-up demand for M&A. Corporate M&A is picking up. Private equity pipelines are picking up. So I'm still optimistic.
What does that optimism look like throughout the year? What is your expectation when we get something that does look back to normal, that does see this pipeline that's being built up really be put into force?
I think on the private market side, you have to appreciate that the structure of the capital actually has a timeline on it. And so one of the things that people need to understand is just the weight of money in the private markets requires transaction activity. And so that $3.2 trillion that I mentioned, half of it is over 5 years old. And there's a desire to get that money back to investors to get the gears moving again. And so even if you don't have M&A, people are going to be looking for ways in the secondary market, for example, to do transactions. So I think you're going to continue to see the weight of the money and the time constraint push companies into the market. And I think on the corporate side, there's a desire to grow too. We did see corporate M&A pick up dramatically even in the last week. I'm sure if you talk to the sell-side bankers, they'll tell you the level of pipeline activity is picking up dramatically. So, I can't quantify what that looks like, but if June was an indicator, and we get some stability here, I think third and fourth quarter could be pretty robust.
You mentioned the tax bills behind us, tariff uncertainty, potentially some of it behind us. You see a lot of signal, less noise coming from that. And then there's this idea of deregulation. Is that what's pushing potentially some of this M&A?
I think there's absolutely a tone. And it's funny, you saw pre-Liberation Day, January, February, just the exuberance with the new administration, pro-business, deregulation, and you saw people come off the sidelines dramatically, and then we took a pause. Now that we've digested, you're beginning to feel that again. So I don't want to say that the animal spirits have been unleashed, but the confidence that the administration wants to push transaction volume is pro-business and focused on dereg, I think is going to be a catalyst for sure. Yeah.
When you talk, I hear an economy flush with capital. I hear an economy that has plenty of access to financing. I hear that financing is not tight in any capacity. We're talking about tightest spreads in the global credit market and public markets going back to 2007. Do you think it is appropriate to start talking about more accommodation from the Fed, or do you think that that's problematic given what you're actually seeing on the ground with some of the companies that you're investing in?
Everything that we're seeing says that the economy is on stable footing. We're seeing continued growth. As an example, we reported earnings in our publicly traded BDC, 13% year over year EBITDA growth. And those companies, while levered, have actually digested the higher cost of capital pretty well. So to your point, we're living in a higher rate environment. The plumbing is working, nothing's broken. Almost every liquid market is near all-time tights. So it doesn't feel necessary to take a more accommodative stance. I think tariffs will be inflationary. I know that there's an argument that some people put forward that it won't be, but to the extent that they will be and the economy continues to grow, that would argue for rates to stay higher for longer, or at least to see a slower trend down.
So, Mike, in this quarter, you had really robust fundraising coming from a variety of sources, but part of that was wealth, too. We're in this environment right now where there's an expectation that the Trump administration is going to open up 401ks to some private assets. You've seen some of your peers, KKR, Blackstone, Blue Owl, already set up partnerships with 401k providers. Is that something you're looking at as well?
Yeah, we're probably the number 2 or number 3 player in the wealth channel right now. We raised about $6.3 billion in wealth product alone this quarter. Close to half of our AUM is in permanent capital vehicles right now. The 401k conversation is an interesting one. I am a huge believer in increasing access to alternatives to the individual investor, whether that's directly or in the retirement market. There's no reason that an individual shouldn't have the same access to alternative assets that institutional investors do. The 401k question, I think, is reason for enthusiasm. If you look at the size of that market and the solutions that are already there, that market for forever has really been fee first. And when we talk about fiduciary duty to the retail investor in defined contribution, it's what's the cheapest solution that I can get? And I don't think that that's the way that you want to be, shopping for investment solutions. It is a complicated set of circumstances in the sense that you still have to get through the executive order, which we haven't seen, although we expect to come. Then we need to see rulemaking. There's going to be a whole flurry of class action lawsuits, I'm sure. We're going to have to get plan sponsors comfortable with the idea, and then we're going to have to demonstrate that we can deliver excess return net of new fee agreements to the investor that get them excited. So we're enthusiastic. We have product that's already geared and ready to go into that market. We have had significant dialogue with potential partners in that market. So if and when that time comes, I think you'll probably see us, jump in, just given our leadership position there. But we're being a little bit more tempered in our enthusiasm.
Yeah, it's interesting to hear some of that caution because other people have decided that this is off to the races for getting that involved in the 401k. And part of the criticism that comes up sometimes is you're going to get players that dump their worst assets in there. And then that brings with it more regulation and hurts the industry as a whole. Is that a real concern?
Yeah, I've heard people say that is not the concern. I think one of the significant transformations we've seen in wealth from prior versions is you are getting the largest brand name managers around the world that are coming into this market with institutional quality product. We're not going into these markets because we have to. We're going into these markets because we want to. And so there's really no motivation or incentive to do that. So I don't really understand that. But one of the things I always try to say to our people and even to our investors in the research community, when the 401k market opens, similar to just the wealth market opening, it doesn't have a transformational impact on what we can do as a manager. I'm just now taking assets that otherwise would find their way into an institutional fund and putting them into somebody's 401k. That's exciting because it now increases accessibility, it opens up new fundraising markets, it diversifies our business, but it doesn't give me a new product to then go into the market and deliver value to my customer. So we're excited about it, but until we get to a world where we're feeling like we're constrained in our ability to raise capital in other channels, I have tempered enthusiasm. If you look at our fundraising this quarter, we had our second largest fundraising quarter on record. We raised about $26 billion of capital this quarter. The fundraising has not been the challenge, I think, for most alt managers. It's really, can I find great quality things to invest in? And so the idea that we're going to continue to bring more capital in, it has as much possible risk as it does opportunity.
Michael Arougheti, Ares Management Chief Executive Officer. You've reported earnings. You go on vacation now?
Monday.
Okay. Well, a lot of people are hoping to do the same. Thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hey, Lisa. President Donald Trump ramping up his attacks on Fed Chair Powell. The president posting on Truth Social this morning, quote, Jerome Too Late Powell, a stubborn moron, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everyone knows has to be done. Elsewhere, shares of Moderna are falling in the pre-market after the company lowered the top end of its revenue forecast for the year. Meanwhile, its second quarter loss came in narrower than expected as cost-cutting efforts offset waning sales of its COVID shot. The CFO saying, quote, I hope it shows investors that we're being financially disciplined. And President Trump making some renovations at the White House, building a new ballroom. The 90,000 square foot space with seating for 650 people will cost an estimated $200 million. The president said that he'll pay for the project along with donors. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, risks to the labor market.
The unemployment rate is still relatively low, but Chair Powell said more than once to a number of questions he thought the risk to the labor market was the downside. We're expecting a 95,000 headline gain, so a step down in the headline gain.
About 45 minutes until that non-farm payrolls report. Sarah Wolfe of Morgan Stanley joining us next. Trying to understand the weakness this morning. Is it because of the tariff rates, or is it just because people are exhausted from so many record highs and such incredible exuberance around American exceptionalism? Right now, it's just taken off a little bit, down about 1% on S&P futures. Really, the dollar has been the story over the past month, given the fact that we've seen such a huge strengthening, a sort of reversal of what we had seen in the first half of the year. Yields just marginally higher, with a whisper number for that non-farm payrolls report in 40 minutes time of 120,000 jobs. Under surveillance this morning, risks to the labor market.
The unemployment rate is still relatively low, but Chair Powell said more than once to a number of questions he thought the risk to the labor market was the downside. And I think that's the concern. We're all looking for signs of which way is it going to break. We're expecting a 95,000 headline gain, so a step down in the headline gain. But we think about the details, really details that are going to be no softer really than June.
Here's the latest. The labor market in focus as non-farm payrolls drop at 8:30 a.m. Eastern. Bloomberg survey expecting 104,000 jobs added and employment ticks slightly higher. Joining us now is Sarah Wolfe of Morgan Stanley. Sarah, thank you so much for joining us. What would be considered a good number and what would be considered a bad number?
I think to Jonathan's point, it really is going to depend on the unemployment rate. So even if we get 50,000 payrolls with an unemployment rate that stays at 4.1% or barely edges up, maybe markets will get a little bit spooked at first, but that's not enough to get the Fed to move. We would really need to see a meaningful move higher in the unemployment rate, as Chair Powell mentioned, perhaps something closer to 4.3%. That would be above the consensus expectations for 4.2%.
Where are you seeing the bulk of the hiring and how much does that matter, right? We've seen, for example, healthcare comprising a huge part of a lot of the job gains over the first half of the year. There was the government employment that's sort of been one of the big wild cards. How important is the composition in this particular report?
Well, we definitely want to see good breadth in job gains because that indicates overall health of the economy. To your point, we were seeing a lot more concentration in healthcare and government. In the last report that we got for June, most of the job gains surprisingly came through state and local employment. And that's one of the reasons why overall payrolls are expected to slow quite a bit from last month. Can we sustain that amount of state and local jobs? Likely not. And so that's going to step down quite a bit. But we're looking at the underlying details, in particular manufacturing jobs. Are we starting to see the trade spillovers weigh on the manufacturing sector? We have not seen that to date yet. And then also looking at other sectors that are related to the trade war, so retail, transportation, and warehousing. We really want to be watching these sectors closely because we're all holding our breath to wait and see how bad the trade disruptions will be on the real economy. And so far, we've seen some slowing, but nothing that's flashing signs of red.
Well, the other potential drag and impact to this labor market has been immigration and just the supply of labor, Sarah. Part of the reason that the numbers themselves have been de-emphasized and we've emphasized the unemployment figure. How much do you expect it to show up? How do we understand what the impact has been at the moment of more deportations, be it self or otherwise, and what's to come?
We're already seeing it in the data. If we look at the labor supply numbers and labor force participation rate, that's been coming down. And it's one of the key reasons the unemployment rate has been staying at 4.1%. Demand is slowing, but also supply. And so what Chair Powell said back on Wednesday was that this creates downside risks to the labor market because we're not just losing supply, we're also losing demand. And so if supply were to start to steady, that deceleration in demand could very easily start to push up the unemployment rate. If we look at the immigration numbers at whole, it's been a massive slowdown. Last year, we were having over 3 million in net immigration. That number is coming in roughly a quarter of that pace this year. And it could come in even lower if we do see that meaningful ramp up in deportation. So it really hits both ways, where it's helping keep the unemployment rate low in the labor market type. But one of the spillover risks is that if you can't hire lower skill, lower education workers, you also cannot hire higher skill, higher education workers for those same projects. So think about construction, for example. Research finds where when you have stricter immigration policy, not only does it weigh on lower skill jobs because you can't start these construction projects, but also higher skill jobs because you don't need general contractors, for example. So we could start to see those types of spillovers as well.
Sarah Wolfe of Morgan Stanley. Sarah Wolfe of Morgan Stanley, thank you so much for being with us. Right now, the expectation, the survey has 104,000 jobs. The whisper number, I love the whisper number. It makes me feel like I've got to go like 120,000. People are expecting that upside surprise, given some of the beats that we've seen in recent economic data points.
It's like it's a secret what Wall Street thinks.
Exactly.
Don't tell anyone. You have to say it underneath your breath.
There's a ticker on the terminal, but carry on.
No, but it's true. It is a more robust figure because we've come to expect that. Do we need to start to expect the opposite of that? Part of that has to do with the labor force participation, I think, that number getting lower and lower. But how much can we brush it off of as that versus something that represents actual weakness?
Yeah, and there's a real question of how policy really goes into this. And Annmarie, we're going to be looking for any further truths. I'm sure there will be them. There already have been some this morning.
Right. The president is really now going after the entire Fed board, saying that at some point they're just going to have to overrule the Fed chair, even though we do know it's a deliberative body. We saw 2 people dissent. Maybe the president is trying to say, anyone else want to maybe be Fed chair? This is your moment to dissent.
Yeah, and is there an economic justification for it? Coming up, we will be talking about that, getting the numbers. Nadia Lovell of UBS, U.S. Trade Representative Jamieson Greer. Do not miss that conversation after the tariffs that were announced overnight. Stephanie Roth of Wolfe Research and Mike Collins of PGIM Fixed Income. This is Bloomberg Surveillance.
The US has a dynamic economy, a strong labor market, and it will outperform a lot of peers.
There are sufficient signs of weakening.
You see consumers cutting their spending back, but continuing to get jobs.
Job growth is slowing down. You could see a bigger slowdown starting even in the next jobs report.
Unemployment rate has been the most important data point you get, for a while now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 30 minutes away from the July payrolls report, a bang to kick off August. And no, it is not just data. It is not just earnings, but also a deluge of new tariff rates on the U.S.'s trading partners. And Danny, right now, the focus turns very much to what we see in the next 30 minutes ahead of that payrolls report, given some of the strength that we've seen in current data.
And part of it is because the tradability of the tariff story itself has really diminished. We've come to accept some of these rates. So in turn, what happens is we need to see the consequences of it, the legacy, the changes that happen because of uncertainty, because of tariffs. And that's where the data matters. This market is numb to the headlines coming in. Potentially what it's not numb is to things like jobs data, the next 2 months of data that the Fed said that it's going to be so important for them. So that's where this focus turns. even if this morning we're a little bit weaker, but not falling off a cliff like we did on April 2nd.
You know, really setting up today's data was the Fed meeting on Wednesday. The idea that you had a Fed chair that said he still sees a stable, a strong, resilient labor market. And then you had two dissents from Fed governors who cited labor market weakness. That's really highlighting how important it is to see whether any of that weakness shows up in 28 minutes' time.
Especially when Jay Powell said that the most important number for him, the main number, is going to be the unemployment rates. That's where everyone's going to be looking at. And then you have the president this morning talking about the fact that, yes, he called Jerome Powell too late once again, but he said if he continues to refuse to cut rates, quote, the board should assume control and do what everyone knows has to be done. Potentially the president here is signaling, I see you two double dissenters. I take this on board, and maybe we should get some more dissenters at the FOMC.
Right now, a lot of turmoil. You bleed it through the markets, and you get softness after a lot of record highs, coming off very high valuations, which have raised some concerns about whether things have gotten stretched. S&P futures lower by about 1%. NASDAQ down around the same amount. You're seeing in the bond market yields just creeping slightly higher at the long end, ahead of what could be stronger than expected data if you believe the whisper number. And you can see that 30-year yield at 4.93%, up 3 basis points. And then in the currency space, it really has been all about dollar reclaiming some of its haven status after the biggest monthly gain going back to 2022. Right now, we do want to head over to Michael McKee, who has some breaking news. After we get there, we're going to be speaking with U.S. Trade Representative Jamieson Greer. But Mike, before we get there, what are we hearing about what Mickey Bowman and Chris Waller said about why they dissented on the Fed's meeting on Wednesday?
Well, the Fed's blackout on speaking has lifted, so we are getting statements from both of those Fed governors this morning on why they dissented, essentially saying the same thing, that they see the cracks in the economy as a bigger danger right now than other members of the committee, perhaps. Chris Waller, he had laid out a rationale for his dissent earlier in the month of July, and he repeats most of that today, that the labor market looks like it's starting to show signs of weakening. He says, I believe the wait-and-see approach is overly cautious and, in my opinion, does not properly balance the risks to the outlook and could lead to that policy falling behind the curve. When labor markets turn, they often turn fast. If we find ourselves needing to support the economy, waiting may unduly delay moving toward appropriate policy. Mickey Bowman's statement is pretty much the same thing. She takes the same tack about the idea of getting behind the curve, saying that she sees the risk that a delay in taking action could result in a deterioration in the labor market and a further slowing in economic growth. Taking a proactive approach in moving closer to neutral would avoid an unnecessary erosion in labor market conditions and reduce the chance that the committee will have to carry out a significantly larger policy correction at a future date. Both of them are careful to say they respect the opinions of the rest of the committee. They're going to work with everyone on the committee. There's no hard feelings here. They just think that it's a little more important to sound the alarm now and maybe be a little premature than wait too long.
Michael McKee, stay close. Thank you so much for that analysis as we wait for the labor market data to show whether this is something that is a slow-moving train and then all at once when it comes to weakness. Coming up this hour, we're going to be speaking with U.S. Trade Representative Jamieson Greer with President Trump's tariff deadline arriving and then sort of being pushed out. Question of how much we continue to negotiate. Nadia Lovell of UBS with stocks on a 3-day losing streak, and Stephanie Roth of Wolfe Research reacting to this morning's payrolls report. We begin this hour with stocks falling as traders await jobs data out in just under 30 minutes' time. Nadia Lovell of UBS writing a strong payrolls number would put downside risk to our September rate cut call. But what continues to be more important for equities is the structural growth story in AI and electrification. Nadia joins us now. Nadia, great to see you. Thank you so much for being here. And we will get to the AI story, but let's start on how hinged this equity market is to the idea of rate cuts. Do they matter?
I don't think that it matters that much. And the reality is, if we don't get a rate cut, it's an indication that the economy is still in good shape. I mean, Powell has said that we're at full employment. If we do get a rate cut, it probably means that the unemployment rate has moved up and the economy is showing signs of weakness, which can cause, some other parts of the markets to rally to finally we're getting a rate cut that can help those interest rate sensitive areas of the market. Right now, we're thinking that, look, if you get something in the unemployment rate that's ticking up closer to 4.5%, that obviously is going to cause a reason for concern. So we could see a bit of a growth scare in the market like we did last year when we saw a 5% pullback in the market. Positions are getting a little bit full, but it also accelerates the magnitude of the rate cuts. And Powell still has time to message out at Jackson Hole.
Well, isn't bad news potentially good news when it looks at the rate trajectory? So if we get a 4.5 unemployment rate, what does that mean for equities?
Temporarily, you could see a knee-jerk reaction because, again, people are leaning into the fact that, growth still remains strong. And so this could be an indication that maybe the Fed is too late, right? And it will take some time for the market to absorb that. Oh, this is an outlier. We know that there are issues around labor supply as well that could be causing some distortion in the labor market. So if you see continuing claims, as we remember, the initial jobless claims has been well behaved. So if you start to see that tick up as well in coming weeks, that could cause the markets to lean into some more that maybe the Fed is too late. But the Fed put is still there to come in and sort of save the day, if you will.
Yeah, S&P 500, you say, is trending towards your upper end guidance. Yes. What kind of catalyst we need to see to get to your year-end target?
I think you need to continue to see the momentum in the AI trade because at the end of the day, off of the April low, that is what's been driving the market even throughout this earnings season. And so if that trade continues, you can see the market push up. At the same time, you need those cyclical areas of the market to sort of hold in there. And that's what's been happening. We're not ready yet to call that 6,700 on the S&P. We do think that near term, there is some risk. The market feels a little bit extended. And we're also entering a period of low, liquidity in August. And so small things can move the market. So near term, you can see the market pull back where for now maintaining at 6,200, we would be buyers at 6,000. But I think in the, in fourth quarter, when we get more clarity around trade and monetary policy, you can make a run for that 67.
I was going to say, does any of this matter as long as the hyperscalers are spending like $400 billion every single year in building up infrastructure?
Yeah. And next year, we think it will be, $500 billion, and it could even move higher from there. And there is question marks about, monetization of that. And you are seeing signs of that. You're already seeing some signs in terms of it, advertising efficiency and so forth. And you're hearing things from Microsoft in terms of Copilot and AI agents to come and things like that. So you are seeing the monetization picking up. And remember, the bottleneck is not only in terms of AI chips. I mean, quite frankly, you heard Amazon say overnight, what's really constraining them is on the power side. So this story is beyond tech. It also includes utility, who has benefited from its pickup in AI spend, and parts of industrial. So it's not just a semi-tech story. It's broader than that. And that's healthy that we're seeing that broaden out of the AI trade.
It's interesting because on the utility point, Neil Dutta has been arguing that it's actually going to be a stress on the consumer. There's not enough energy for the AI players. They use more of it. It becomes more expensive for households. They also have to pay that more expensive bill. Have we fully thought out some of the ramifications of this increased spend and build out from the big AI players? Are there going to be some consequences that maybe put some more pressure on things like that, like the consumer?
Potentially, and you're hearing some of the states talk about that as well, the need to build out. And you have companies that are going direct. Some of the hyperscalers are going directly to the power generators. And so that could help alleviate some of the pressures. But again, these are still known unknowns that needs to be figured out. And there's a potential for upward pressure on electricity prices. But ultimately, these companies do have deep pockets. So we think that the cost will be spread and end up on that side.
Meanwhile, we are just careening toward that jobs report, and it raises the question how much it matters, right? I mean, you're talking about all of these things, whether it's investments in energy, whether it's investments in AI, that might not actually help add jobs all that much, some of these aspects. Meanwhile, there's a real question from the White House about whether there is a real weakening in the underlying labor economy. President Trump just putting out on Truth Social, strong dissents on the Fed board. It will only get stronger too late. How much is there a relationship and how much is it broken down between the labor market, what we get in 20 minutes time, and the stock market performance, particularly in large caps?
Look, we all know that, on Jobs Friday, there's always knee-jerk reaction to the data. And so, look, you could see if the numbers are weak, you see that knee-jerk reaction heading into the weekend. we're heading into summer vacations, taking some risks off of the table after a very strong rally, wouldn't be too surprising to us. But again, I do think that at the end of the day, what's going to matter for this equity market is the earnings growth. And this for second quarter, we're seeing very strong, trailing, trending towards 10%. And in fact, when you look forward to the third quarter earnings, it's actually holding in there in terms of the forward estimates. And that's bucking the historical trend when normally you see, trims to the forward estimates. So I think that's encouraging from the standpoint, and a lot of that is being driven by tech, comm services, and financials. There's still that deregulation story that needs to play out as well.
We've all been trying to wrap our head around this, and I know that that Annmarie as well as Danny have been talking about this, the idea that some of the efficiencies that we've been getting from the technology come at the expense of workers, right? That the cost savings that have added to the revenues that have mitigated some of the effects of the tariffs have come from artificial intelligence taking over certain roles that humans used to play. How much could you see ongoing expansion of margins with a labor market that continues to soften and become more difficult for people to find jobs?
I don't think that that's a today issue. It's a future potential issue that we need to address. And you're not seeing it in broad spread areas of the economies. Definitely not seeing it in UBS. And we are an active user of, Copilot. Microsoft has mentioned it a number of times on their earnings call. So not seeing that yet, but do think that it is a future problem that needs to be solved. But like any technological innovation, that usually comes with new areas of jobs being created as old areas get, less emphasized. And so it remains to be seen what the overall impact, but I think it's too early to tell what it will be.
The past week, the past month has been about American exceptionalism reasserting itself for all of these reasons. How much are you leaning into that versus going the other way, just on a valuation story?
Well, valuation, as we know, it's not an indication of sort of where the market is going to go over the short term. Like, is valuation getting to the high end of that range again, 22.5 times for the broader market? Yes. Does it start to, have the market pull back? We don't think so, because the earnings growth is there to support that. And I think the American exceptionalism comes down to our technology here, the innovation. And now you have an administration also that is leaning into that and supporting that and removing some of the restrictions around semiconductor chips and AI technology. So we think that, American exceptionalism from a technology standpoint will continue. And you're starting to see the dollar gain a little bit as well this year. So don't think the story is over. The margins are envied by the world, and we don't think those margins are going away.
Nadia Lovell, thank you so much for being here. Happy Friday. I'm allowed to say that today. Nadia Lovell of UBS. We appreciate it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. President Trump unleashed his latest round of tariff announcements just hours before his August 1st deadline. Most countries are facing a baseline 10% tariff rate, but Trump slapped 35% levies on Canadian goods not covered under the USMCA. The new tariffs will take effect August 7th to give US Customs and Border Protection time to prepare. And shares of Amazon are falling in the pre-market, the online retail giant projecting weaker than expected operating income. It's also trailing the sales growth of its cloud rivals, leaving investors wondering whether its huge investments in AI are actually paying off. CEO Andy Jassy said it's very early days in AI and that the company's efforts to lower the costs will draw more customers over time. In contrast, Apple shares are trading higher in the pre-market. The company reported its fastest quarterly revenue growth in more than 3 years, with revenue rising 9.6% to $94 billion. Strong iPhone sales and a rebound in China helped beat estimates, despite a projected tariff hit. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, we'll be speaking with U.S. Trade Representative Jamieson Greer as President Trump's tariff deadline arrives with quite a bang. That's next. This is Bloomberg Surveillance.
We talk as if tariffs drive the entire U.S. economy. They don't. Goods subject to tariffs represent 9% of GDP. I don't want to minimize the impact, but tariffs don't drive the entire U.S. economy. The consumer is doing just fine. Hey, we have fiscal spending that in our minds is going to be stimulative.
That was Sebastien Page of T. Rowe Price as we try to assess just how important some of these tariffs are going to be for the trajectory of growth going forward for the U.S. economy. Right now in markets, we do see a bit of softness as markets digest the new tariff rates, as well as sort of disappointing news from Amazon. It's hard for me to call it. They did beat. You see S&P futures lower by about 1%. You can see a more pronounced weakening in the Russell 2000. Really, the dollar strength has been notable, the sort of reassertion of whether we are seeing American exceptionalism once again. 114 on euro dollar, and yields marginally higher, 3 basis points higher on the 10-year as people look ahead to potential resilience in the labor market and the U.S. economy. Turning to our top story out of Washington, D.C., President Trump announcing new tariff rates around the world set to take effect next week. I am so pleased to say that U.S. Trade Representative Jamieson Greer is joining us now. Jamieson, Ambassador, thank you so much for being with us. I know you've been incredibly busy. I can imagine you haven't slept much. I am curious how much we're seeing the end of negotiations or the beginning of the end, as there still seem to be some loose ends to be tied up.
Well, I would say that, we've spent the past 120 days negotiating with dozens and dozens of countries, and with some of these countries, the deals have been good enough that the president's been willing to accept them. With other countries, they're just going to have a tariff. But we have, you can look at some of the information that's gone out there. We have fact sheets. We have a joint statement with Indonesia that gives some details. We'll be finishing the paperwork in the next, weeks and maybe a couple of months. But these deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system. And so we'll be, finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
Ambassador Greer, can you help us understand how you landed on some of these rates? Specifically, a country like Switzerland, it went from 31% on Liberation Day, April 2nd, to now 39%, even though you and your colleagues were in negotiations with the Swiss trading partners.
Sure. Well, so first of all, the rates are largely determined by the trade deficit of a country with the United States and what the country's willing to do to address that trade deficit. Switzerland, this is surprising to some to hear, but we have a nearly $40 billion trade deficit with Switzerland for a country of 9 million. Now, we value our relationship with Switzerland, certainly, but during our discussions with them, we weren't able to reach agreement on the best way to reduce that trade deficit. At all, right? They ship enormous amounts of pharmaceuticals to our country. We want to be making pharmaceuticals in our country. So this is a challenging situation. And so we have, high tariffs, not just on Switzerland, but many countries where we weren't able to fully resolve a path forward on reducing the trade deficit and opening markets.
My understanding was that the U.S. and Switzerland actually had a negotiated text, and it was just waiting on sign-off from President Trump. Is that accurate?
I think that's an overstatement. I mean, the reality is all of these countries, you trade back and forth paperwork, and then you take it back to your leaders to get guidance from them. And so nothing's agreed until everything's agreed. That's what every trade negotiator knows. So, the reality is we negotiate with lots of countries. Listen, there are a lot of countries that didn't get a deal that we've been negotiating with. And they, of course, they all want a deal. They all want to deal with the United States. So I can understand that, folks may want to try to manifest a deal in the last minutes. But we just have to do what's right for America, and the president understands that, too.
I'm thinking of other countries like Taiwan, which that rate went down. India, Switzerland, of course, we know you are in negotiations with. So between now and August 7th, could some of these countries that you spent a lot of time with your counterparts get a deal?
Well, that's not my focus. I feel like we've been able to get everything set on August 1st. Of course, any country that wants to talk to us, they can always talk to us. And I'm sure some will be eager to find ways to reduce the deficit, open their markets, et cetera. But we're really focused right now on implementing the deals that have been reached.
Well, on implementing those deals, Representative, you mentioned that you would be looking and monitoring them for any violations. How will this administration judge what is a violation and what the consequences of that would be?
So, for example, we put out a fairly detailed joint statement with Indonesia, and we're finalizing the underlying agreement. And in there, you can see that they've made commitments on tariff levels where they're going to remove all of their tariffs. They've made commitments on non-tariff barriers with respect to, agricultural inspections and the way they treat certain digital trade. And so our office, which has hundreds of people, the Office of the U.S. Trade Representative, they watch this and they make sure that Indonesia actually does what it's supposed to do. And if they don't, the president has his tariff authority. I mean, all of the deals are premised, and the modified rates for these countries are premised on them actually opening their market, making the investment and purchase commitments they've agreed to. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here.
Ambassador, right now there are a number of countries coming out and saying this is part of a negotiation and they plan to keep talking with the team over in the trade organization and trade representatives from the United States. Is that just messaging to their own political constituents, or is that reality?
Well, listen. They certainly have their domestic constituents they have to talk to. You can be sure that I woke up this morning to a number of trade ministers texting me and emailing me, and I'm sure they're reaching out to my colleagues, Secretary Lutnick, Secretary Besson, et cetera. And my job is to talk to these folks. I'm always going to talk to these folks, and if they have proposals, I'll talk to them and I'll brief the president. We're focused on implementation and doing what's right to change the trading system to one that benefits American workers.
How much are you also hearing from U.S. companies concerned about certainty and whether they're going to get clarity on exactly what the rates are going to be, whether they will stick, whether there will be adjustments, and how some of these things will work with transnational shipments of getting penalized 40%?
So with respect to certainty, President Trump has been talking about a new tariff program for literally years, decades in some instances. He has tariffs from his first term that are still in place. So sometimes when companies say we want certainty, what they mean is we want a different outcome, right? By putting, the market has baked in a lot of the tariffs we've put in. The new tariffs that we issued last night are firm. That's why we put it out in a very clear list. Everyone can see it and understand. With respect to transshipment, that's always been illegal. And so we're just going to put an additional 40% tariff on that. So, I understand that there are going to be edge cases where companies have to change their supply chains, and no one wants to do that. They just want status quo. But we can't have the status quo. The status quo is what led to offshoring and the loss of some of our key industries. So during that supply chain shift, that can be challenging for some companies. And I talk to a lot of these folks. I want them to understand the president's trade policy. I want to hear about any unintended consequences. But the president's trade policy is moving forward, and we're shifting from a 70-year policy based on purely efficiency to a new policy based on fair and balanced trade, and the world is agreeing with us.
Ambassador Greer, what about the unintended consequences of what's going on with the sectoral tariffs on autos? The Ford CEO was on Bloomberg Television yesterday talking about the price disadvantage compared to auto companies if they're making a car in Japan because of the input costs of 25% on those inputs that they need to make the car coming into the United States versus the 15% rate that Japan now has. What's the point of the auto sectoral tariff if basically it's going to be bilateral now with country by country?
So first of all, there are only a handful of countries that export cars to us, right? It's essentially, Germany, Japan, and a couple of countries of the European Union. We also have Canada and Mexico, and we had our domestic producers, choose over a couple of decades to offshore a lot of that production to Mexico. And so naturally, there is some challenge as they continue to reshore that, and we understand that, right? I mean, our goal is long term. We're not looking at quarterly earnings as policymakers. We're looking at a way to make sure that we have a strong, robust industrial base here that provide good jobs for our workers and support the national security. So, we're in constant contact with the domestics, with the unions, and everybody. And, I understand that the auto companies are receiving a credit for content that's made in America, which is how it should be. That's what we're trying to incentivize.
When you're looking and you're thinking long term, are you preparing for a Supreme Court ruling against using IEEPA for these tariffs? And if so, what's the plan B?
So the case is at the federal circuit right now. We had the arguments yesterday. Lots of questions, a lot of preparation. DOJ did a great job. We had a great team out there. We feel very confident in the case. If there's still questions coming out of the federal circuit or further litigation that goes to the Supreme Court, we're confident there that this statute clearly says the president has the authority to regulate imports. That's the language. No, not my words. That's the statute's language. In case there's a national emergency, the president's declared a national emergency. So we feel confident, if it goes the other way, then we'll manage that. The reality is the countries understand the type of leverage that President Trump has created. That's why they're doing these deals, and they're going to stick regardless of what happens in litigation.
That's where I wanted to finish, and we just have a couple of minutes. We are out of time with you, I know, but I am curious what the game plan is. Should there be some sort of overruling of IEEPA? Do you already have Section 232 and others lined up?
Well, listen, we always have all kinds of plans, and I'm not going to go deep into our strategy here, mostly because we're pretty confident on the current plan. But we will do whatever it takes to make sure that the president can continue to rectify the trade deficit and change the global trading system. And this is a historic thing. This is once in 100 years that you have the chance to reorder global trade like this, and we're doing it, and we'll use whatever tools are necessary to do it.
U.S. Trade Representative Jamieson Greer, thank you so much for being with us. I'm not sure when you sleep, and we've been talking about that with you and Scott Bessent as well. Ambassador, thank you for your time. I appreciate it. Really a slew of changes at a time when there are some real questions over what the ramifications will be, but historic in terms of magnitude, that's for sure.
Oh, yeah, historic. These are the highest tariff rates we've seen since the 1930s. What was interesting, he said that a lot of these countries want to manifest deals now. I want to know, I think the market wants to know between now and August 7th, I think the market's trading on this. They are still in negotiating mode. He said he woke up to a number of text messages from his counterparts, from negotiating partners, wanting to get to end. Potentially, is this the final moment we can see these concessions the administration has wanted from places like India, maybe when it comes to things like Russian oil, from Switzerland, maybe things like pharmaceuticals, from Taiwan when it comes to semiconductors? Is this the final stretch for some of these big trading partners?
Meanwhile, we are just about a minute away, less than a minute away from the payrolls data, and a real question, Danny, about how much the ramifications from any of what we've seen on the headline turmoil that we've seen has filtered into labor.
It hasn't filtered through yet. Will it start to change? That is a question. But the fact it hasn't filtered through yet means that a lot of this market has been able to look through some of the drama and not necessarily trade it because it's not showing up in the economic data quite as much as we expected.
What we are expecting is 104,000. That is the median in a survey of economists for the number of jobs created in the month of July. We're also expecting the unemployment rate to tick up by 10 basis points, 4.2% from 4.1%. The whisper number is 120,000. The potential of what is the break even going into that right now. S&P futures are lower. Right now, let's head over to Michael McKee with the numbers. Mike, what do you see?
Well, we got a very disappointing number here, and this is going to get Wall Street's attention. 73,000 jobs created during the month of July. The forecast, as you said, was for 104, and we came down from 147 last month, looking to see what the revisions are. Right now, the three-month revisions add to payrolls by 35,000, so that has to be factored in. Private payrolls, 83,000. They were 74,000 last month. So it looks like government has subtracted from the overall level of jobs. And that would be a rebound or a going back basically to the seasonals issue that we saw in June. Unemployment rate, 4.2% as forecast. We'll look at what the three-digit number is in just a second. Average hourly earnings up 0.3 as forecast. Average hourly earnings on a year-over-year basis at 3.9%. They were 3.8% the month before, so it looks like a little bit of a gain overall for people. I'll dig into this some more and let you figure out how the markets are reacting to this disappointing headline number.
Mike, that sound that you hear, that whoosh, is the two-year yield plummeting, and that is what we're seeing, down more than 10 basis points in response to this weaker than expected number. You can see equities have maintained some of the losses that they saw from earlier, but across the board, a bid into bonds is the big trade. 10-year yields down 5 basis points. The two-year yield, this really is the key moment, down 12 basis points to 3.84% as people take a look at what this labor market report means for the Federal Reserve. In the currency space, we had been seeing quite a bit of dollar strength on expectation that the Fed would have to remain really strong with policy. We see a complete reversal, the euro bouncing versus the dollar, 114.81, as people assess that maybe this will be a Fed that will get pushed into cutting rates sooner and faster. Really, the idea that you could see the number come in softer, as well as the unemployment rate also ticking just slightly higher here concerning, or at least provoking a response that would imply more rate cuts. Mike, you've had some time to dig through some of the numbers. Really notable to me that the change in private payrolls came in slightly lower than expected, but manufacturing so much lower, actually a contraction there. What stands out to you?
Yeah, you've got 11,000 jobs lost in manufacturing, and we had seen signs of this coming in some of the ISM reports, and we do get ISM for July coming out at 10 o'clock this morning. But it does suggest that the companies in manufacturing at least were not ramping up at all. They've lost a few thousand. Construction, only 2,000. There were 13,000 that were supposedly found by ADP in their numbers on Wednesday. So construction, not really a surprise given the circumstances and what we've heard about construction overall. Service producing jobs, 98,000. That's a low number, but in line with the fact that service-producing jobs are the majority of jobs in the economy. And then, of course, the number that really has set the tone here is the government jobs. We see 12,000 jobs lost at the federal level, and that's going to just start picking up because a lot of people who left the federal government under DOGE got some sort of severance, and they don't count as unemployed as long as they are getting severance. So we'll see more of that. Overall, government, including state and local, down 10,000, and that is a rebound from last month's 74,000 jobs created, most of those in state and local government because of education, and economists think that was mostly because of a seasonal adjustment problem. I didn't mention earlier, but we should point out that the average work week rose by 0.1%, 34.3, and that may suggest that even though companies were laying some people off, to keep up with business, they had to work others harder. So a little bit of a buffer on the other side.
As you speak, Mike, we're seeing the two-year yield just plunge that much lower. Michael McKee, thank you so much. So if you are just joining us, here's the state of where we are. We did get the non-farm payrolls report for July. 73,000 is the number we got. 104,000 was the expectation. We see that increase in the unemployment rate as expected from 4.1% to 4.2%. We did see average hourly earnings still go up by 0.3%. But as you parse into the numbers, here is what is accelerating that downward shift in yields, that upward shift in expectations for Fed rate cuts. The revisions in non-farm payrolls for the month of June came in at 14,000. That is downgraded from 147,000. I had to do a double take, Danny, if that was accurate or not. But you really see that downward revision in the prior month coming into play in a massive way.
June goes down to 14,000. May goes down to 19,000. That makes 73,000 today look all that much more weak. I think that's going to be the thing that catches a lot of attention this morning, not necessarily the number that just comes in, because if the revisions continue to stack up that way, what is 73,000 actually? Is that even a lot more weak?
Neil Dutta of Renmac goes right to Twitter. Waller looks vindicated. It was Christopher Waller that on this program talked about just weeks ago, before he made this dissent, that he is seeing cracks in the labor market. And we are seeing that today when it comes to this unemployment report.
Yeah, and I'm sure that we'll get some more Truth Social posts on this. Joining us now is Stephanie Roth of Wolfe Research. Stephanie, you've had a couple minutes to look through this. Is this a terrible jobs report, or is this a little bit more complicated?
It's pretty bad, especially in the revisions. I think that's the biggest thing. I mean, the 258,000 of negative revisions to the prior 2 months is pretty eye-opening. Of course, we're all watching the unemployment rate because that's what, for a couple of reasons, that's what Powell is telling us to focus on, which remains, up a little bit, but fairly steady. I think what we're seeing is the massive impact from immigration having important implications on the labor market, and that's what's driving at least some of these negative revisions.
When you look at the market reaction, though, it looks like they're pricing in September and October for Fed rate cuts. If we see another weak job report, is that what you would expect?
I think there's certainly a chance of that. That said, the inflation data are also going to be pretty elevated in the next couple of prints. So it makes it a really tough backdrop for the Fed in this landscape. And this is something we've been warning our clients about for quite some time, that risks are quite elevated over the summer because we're going to be in an environment where immigration is going to have very negative impacts on the net hiring of this economy. The unemployment rate might remain okay, and inflation is likely to be quite elevated. And that's a really toxic backdrop for the Fed to be able to cut.
We do have, though, 73,000 for non-farm payrolls, weaker than expected, 4.2% unemployment rate ticking higher. What is the line in the sand for this unemployment rate that Jay Powell is saying is what he's mainly looking at, the main number?
I think we're talking somewhere between 4.3, 4.4, 4.5 for sure that they'd be cutting, but I think it has to continue to creep higher throughout the course of the summer in the backdrop that inflation is going to be quite elevated.
Is this Waller vindicated, what we're looking at right now? Is this the dissenters saying that the labor market is weak? Is this a hat tip, a vindication of that?
I still kind of think that it was a little bit political. However, the data do happen to be consistent with that message.
So if it's consistent with that message, but it's still political, how much weight can you put into that? If they continue to go forward and you have President Trump, who was on Truth Social this morning saying that the board needs to take over, that they should be the ones dictating policy. If you start to get more of the dovishness from the board, do we have to continue to write it off as political? Do we just put less weight in it from here on out?
I think if you see other members continue to get more dovish, I think that's important. We all knew that the dissents were going to come from those two board members, right? So if you start to hear more dovishness from the rest of the committee, I would imagine Powell will also feel the same way, because that would be consistent with the actual data. Those two members in particular were known to be, having some sort of more political leanings to some extent in recent times. The rest of the members, if they start to become more dovish, I imagine Powell will be right alongside them. And that will be because the data continue to show that the employment backdrop is weakening.
Meanwhile, we're looking right now at markets, the two-year yield continuing to fall, down 15 basis points to 3.8%. You have seen it come in even more. I just wonder if this really does set up September in a way, Stephanie, that is unassailable in terms of cutting rates, given the fact that especially the revisions, that tends to be a leading driver of the direction of travel. Isn't this something saying September has to be back on the table in a massive way?
Yeah, I think that's totally fair. And if you look at the details within the household survey, the main driver of the sort of the softness this month in employment was foreign-born population. So I think this is exactly what we're seeing, the massive implications of the immigration policy having effects on the labor market.
Stephanie Roth of Wolfe Research, thank you so much for being with us on this non-farm payrolls day on this Friday. I do want to get back to Michael McKee, who's been parsing through all of the details. Mike, what have you found as you've gone through it?
Well, Stephanie was just talking about the issue of immigration and how that might have affected the numbers overall. We did see a drop in the labor force of 38,000 and a revised drop from last month of 130,000 in the labor force. Now, of those who dropped out of the labor force this time, 341,000 in the foreign-born category. So a major drop in the number of people who are either legal or undocumented in their participation in the labor market. And that, I'm sure, has a role to play overall in what we're seeing now.
Mike, stay close. I'm sure you'll get more as we parse through all of that. Joining us now is Michael Collins of PGIM Fixed Income. Really fascinating point there by Mike on the immigration side of things. From your perspective, how conclusive is this labor market report about September and a rate cut then, and frankly, about deterioration in the U.S. labor market?
Yeah, Lisa, good morning. Right now, there are two full cuts, again, priced in for the rest of this year from, only about 35 basis points priced in an hour ago. So big shift, obviously, in expectations. And I think that does make sense. I think it is justified. But this is a trend that Powell talked about actually a lot in his press conference that we've been talking about. In fact, we discussed it a month ago, Lisa, that maybe we're in a world, given the immigration and deportation policies, that a 0 to 50,000 monthly gain in jobs is the new normal. That's the new run rate. And here we are with those revisions, as you pointed out. We are kind of in that world. Interestingly, again, as Powell pointed out, the unemployment rate is pretty sticky. The hours worked ticked up, the earnings, the wages ticked up, right? So there really aren't signs that the labor market is weak, that there's a big offset in supply and demand. It's just that the supply has shrunk a lot, and it will continue to. And it's, obviously the government jobs is a demand story, but we're just kind of decelerating into a lower run rate of jobs, which of course translates into a lower run rate of GDP, right? If you look at consumer spending so far in the first 6 months of this year, Lisa, we're running just below zero, right? Real consumer spending, which is obviously correlated to GDP. So we're kind of in this really low growth world right now that we've been expecting.
Well, the participation rate is down. As you say, unemployment rate up in July, despite the exit of people from the job market. Isn't that worrying for the Fed? Are they potentially behind the curve right now?
You know, it really depends, right? This is the conundrum that the Fed has, and I actually give Powell credit for talking about this, that if job growth is weak, but the unemployment rate, the balance between the supply and demand for jobs isn't that out of whack, meaning the unemployment rate ticks up to 4.5 and stabilizes there, you know, that's something I think the Fed would generally characterize as relatively full employment. I think it's when it starts to shoot toward 5. And certainly if we see a 5 handle, they'll probably be cutting in earnest, you know, not talking about 25s and 50s, but, you know, getting that funds rate down to 3 really quickly.
Even so, Mike, just looking at some of the details, it looks like healthcare accounted for 75% of the gains that we saw in this employment report. It was the main engine of growth. Is there a concern about the breadth of jobs being added? Should we add that to the ledger of reasons to be concerned about this labor market?
Yeah, absolutely. And this is something that certainly my colleague Tom Porcelli has been speaking with you about for months now, that if you take away government jobs in healthcare, i.e. the kind of non-cyclical, you know, structural jobs, the cyclical job growth has been really weak all along throughout the whole year. And this is just really a continuation of that trend.
So what do we do from here, Mike, if we are still in this period where there is some weakening, but it's not weakness? The rally that we're seeing in the front end, is that something that you'd want to chase at this moment?
Yeah, you buy bonds, right? I mean, it's a big, beautiful bond market, and returns have been substantial, and they're going up, right? Yields are really high, and we've been certainly advising clients, you know, take advantage of these rates while they're high. I mean, you know, the old adage is don't fight the Fed. You know, my new tagline is don't fight the triumvirate, right? You have a president, a Treasury secretary, and ultimately a chair of the Fed that all think rates should not be, again, 25 or 50 basis points lower, but potentially hundreds of basis points lower. And I think that maybe will be realized over the next few years.
Mike, certainly people are buying bonds today. We can see that across the curve, although much more so on the front end. When you say buy bonds, I am curious which bonds. At what point you can really start to extrapolate out longer term, 10-year, 30-year rates and say it's a good time to lock that in at a time where there still are longer term questions about the tariff rates that we got last night, how long-term inflationary they'll be, especially if the Fed is prompted to cut rates.
Yeah, I mean, really across the whole curve. Obviously, as you're seeing today, that 2, 5, 7, 10-year, that kind of short intermediate part of the curve comes crashing down the most. That's where you get the most bang for your buck, Lisa. Meaning, you don't have to take a lot of interest rate risk to get a lot of benefit. But the whole curve, right now the funds rate that's priced in for the rest of our lives is 3%. Meaning the Fed gets to 3 by the end of 2026 and keeps it there and actually increases it a little bit for the next decade. What's not priced in is a 2-handle or a 1-handle funds rate, right? So that realization could cause a whole curve to kind of come crashing down. So you don't want to just lock in a 2-year here, because then you have 2 years of duration, 2 years of reinvestment risk effectively. And we've been encouraging investors to inch out on the curve and to extend duration, maybe not, go absolutely long to 30-year, but add duration.
Stephanie Roth of Wolfe Research still here, and I'm looking right now at some of the internals of this data, and it includes average hourly earnings that ticked up to 3.9% from the previous 3.7%. You can see right now across the board, there are still signs that things are solid. Even the unemployment rate, yes, it ticked up, but not to the significant degree that some people were worried about. What is the inflationary risk here longer term at a time when the Fed is being prompted to cut from a number of different reasons? And there still are these tariffs in the system.
Yeah, this is a challenge, because the data that we're seeing largely appears to be driven by immigration, and that actually tightens the labor market for blue-collar workers. So what we might see is a labor market, which is something that was kind of known heading into this event, but it's now the reality. It's kind of painful, because what we're seeing is job gains that have slowed down tremendously. it results in upward pressure on wages and then upward pressure from tariffs. So it's like a stagflationary type of shock, which we're starting to see play out in the data. It's just a really complicated mix for the Fed to kind of deal with from here. So it looks like the labor market is okay. It's not as weak as these numbers today suggest. This is largely driven by immigration in an economy that's hanging in there.
Mike, to that point, maybe the economy is hanging in there, but on the margins, is this buy government bonds, sell corporate bonds?
You know, corporate bond spreads, as you know, as we've all been talking about, are really tight, meaning you're not getting a lot of extra yield to buy corporates and high yield bonds. And obviously you're seeing a little bit of a knee-jerk reaction, a negative reaction in the stock market as well. And this, you know, this whole tariff theme is definitely one of not only inflationary, you know, as you know, we just talked about the stagflationary risk is real, but it can certainly result in margin pressure for companies. And I think that is still to come. And I think we are starting to see some early evidence of that. And obviously that could put some pressure on corporate earnings. That could put some pressure on credit quality and on corporate spread. So yeah, I think higher quality bonds and adding duration are the two themes we've been sticking here. The big question for the Fed, right? And Stephanie, you kind of talked about this. If let's say growth is 0 and the unemployment rate is, 4.5 or 5, but inflation is at 3. You know, what does the Fed do in that world, right? That kind of stagflationary world. And my gut is, the Fed and even Powell, who is a labor market dove, would err on the side of saving the economy, saving jobs, saving the labor market, and write off this inflationary risk as being a one-off. So I think that's the kind of the risks, the way they're skewed.
Mike Collins of PGIM Fixed Income, thank you so much for your time. And before we got this number, we saw a 40% chance of a rate cut being baked into the market for the month of September. And right now we have a 71% chance of a rate cut in September. Joining us now is Jeff Rosenberg of BlackRock. We heard there from Mike Collins, buy bonds. Is that your takeaway?
Well, it's certainly the market takeaway because the market's repricing September, and it makes a lot of sense, and you guys hit on it, and I think it is the takeaway from today's report, which is it's the revisions story. Remember, there's been this undercurrent of a debate about whether non-farm payrolls in the labor market report is really mismeasuring the deterioration, and you see that in these first prints versus the revisions. Waller's talked about it. It's a little bit of vindication here, and that's basically saying his argument may hold sway or convince more people to come on his side of the argument. And, maybe they missed the opportunity in July, but it certainly raises the odds that you get it in September. And that's why you're seeing the big move, as you pointed out, in the front end of the curve.
Well, the president agrees with you. He took to Truth Social and said strong dissents on the Fed board and will only get stronger. Given the revisions, the downside revisions, is this now a trend of this fragility we're seeing in the labor market?
Well, it was one of the numbers that Mike highlighted at the beginning. When you take the revisions into account, the 3-month average change on non-farm payrolls drops from 150,000 average, which is really a very, pretty strong labor market, to 35,000, which is a dramatic shift. Now, as Mike just mentioned, maybe we need to reset what we think is break even. But with the revisions, it's a dramatically different picture to what the labor market is saying. And as also Mike was talking about, you have a pretty strong year-over-year average hourly earnings figure, wage inflation. The market is not caring about that because I agree with Mike. I think in the debate between the dual mandate of inflation versus full employment, they're going to err on the side of full employment. And that's why, again, I think you're seeing this big move in the front end of the curve, despite, what we're not really talking a lot about, which is the wage number.
Yeah, Jeff, I just wanted to jump in because we had heard from Powell this week who de-emphasized the non-farm payroll numbers themselves and said, pay attention to the unemployment rate. And we were just talking with Stephanie about this idea of it being impacted more by labor supply and things like immigration. So given that, couldn't you say maybe for this bond market, I shouldn't get over my skis in joining this rally because we did have things like PCE yesterday, which showed a stubborn rate of inflation?
Yeah, it's a really good point, and he did focus on that, and the unemployment rate, ticked up 1/10, and that was kind of aligned with expectations. But he also said in that press conference that the slowing in the labor markets, even if it's both demand and supply with the equilibrium, raises the risk that the downside risk would be to labor markets. It was a little bit of a tell on, yes, we're in equilibrium now because you're getting both the supply and the demand side falling, but the risk is that the supply side sort of stops falling and the demand side continues. And I think that's kind of what the market is looking through here, particularly around this trend with the revisions, more accelerated than, say, what we've seen in terms of labor force participation, which you mentioned a minute ago, which actually ticked down here again 1/10. But maybe you start to see that stabilize while the demand side doesn't stabilize, and that's the risk that the market's pricing in right now.
Jeff, not all markets are pricing in things equally. I just pulled up what the futures session is doing. You actually, just looking at the line chart, would not even have any idea that we had any big economic piece of data come out. S&P 500 futures are basically at the level they were before. Is this a market that's not paying attention to the jobs numbers, or it's just not bad enough for them to react, or maybe it's smooth sailing because it means that we could get cuts? What do you make of how risk is not reacting?
Well, and I looked at some of the futures and they looked like they were reacting and down. I think when you look cross market, we talked a little bit about this earlier this week. You got to be a little bit careful about reading into the equity market. This is very much sort of a macro conversation, Fed policy, macroeconomic performance. The stock market is not the economy. And the stock market is not even the S&P 500. It's really the S&P 7 or 6. And then you've got the 493. There's tremendous differential. Look at sort of small cap performance versus, S&P 500 performance, which is, again, it's sort of more dominated by the tech story. So those stories, and we're in the middle of earnings season, they can be much more dominant and reflective of those issues than they are what we're talking about here in the macro data. I think when you look at the 2-year, that's mapping to Fed expectations, and that's a pretty good message. I think when you start looking across into the equity market, you got to be a little bit more aware that, there's other factors going on in this environment of very concentrated equity valuation within the indices that can kind of lead to a misread across from the macro data.
Jeff Rosenberg of BlackRock, thank you so much for being with us. And as Jeff was talking about, the chances of a September Fed rate cut were increasing yet again to 76% now from 40%. Stephanie Roth of Wolfe Research here with us. For a final thought, you've been parsing through all of this. Notably, the 3-month average of the net change in jobs has fallen to its lowest level going back to July of 2020 or June of 2020. What's your takeaway?
I think the labor market has softened. A big part of it has to do with immigration. Another big part of it has to do with government. About half of the revisions are driven by the government sector. So we're looking at an economy that's holding up. Labor market has cooled down, and inflation is going to be heating up. This is a really challenging backdrop for August for risk markets.
Annmarie, the president's responding. He's coming out on Truth Social.
Yeah, he's not exactly saying what's happening in the jobs market, but he's signaling this is the reason why he thinks the Fed is, quote, his words, too little, too late. Powell is a disaster. Drop the rate.
And meanwhile, the S&P not even responding. It's all about big tech.
No, not responding at all. Again, you would have no idea that this piece of data came out. It is the bond market that is responding, sending us to a more than 70% odds that we will get that rate cut next decision.
Stephanie Roth of Wolfe Research, thank you so much. Coming up on Monday, Ed Yardeni of Yardeni Research, Michael Gapin of Morgan Stanley, Michelle Meyer of the MasterCard Economics Institute, and Vinu Krishna of Barclays. This was Bloomberg Surveillance.